Hello, everyone. Welcome to the second day of our workshop. Today, we have three great papers on monetary policy and fiscal policy. Just as a reminder of the format of our workshop. So every presenter will present for 35 minutes. Then our discussant will give a 15-minute discussion of the presentation and the paper. After that, there will be a 10-minute open discussion. During the presenter's presentation, feel free to ask clarifying questions. Okay, our first presenter is Anthony Zhang. He will tell us about monetary policy transmission and segmented markets.
Great, I'll get started. Thanks a lot for the introduction. It's great to be here. Thanks for putting together this very nice conference. So I'm presenting a paper titled Monetary Policy Transmission in Segmented Markets. My co-authors are Jens Eisenschmidt at the ECB and Yiming, who is here. So Jens is at the ECB, so the standard disclaimer applies. Okay, so jumping into the paper. Topic of this paper is monetary policy transmission, and in particular, monetary policy transmission through the repo market. So the first stage of monetary policy transmission is the central bank sets rates, money market rates for banks, right? And then so these money markets, short-term funding markets, short-term interbank markets are the first stage of monetary policy transmission. And in particular, money markets have increasingly become secured post the great financial crisis, right? So here is a simple plot of breakdown of volume in the European money market, right? And then prior to the crisis in around 2003, you see that there's volume in overnight index swaps, unsecured borrowing, FX swaps, so on. And sort of increasingly post-crisis, sort of most of interbank activity comes in the form of repos, right? So for those unfamiliar, a repo is simply a secured loan, a short-term secured loan, right? So I have say a German government bond. I would like to fund the German government bond. I can basically make an agreement with Yiming to say, I'm going to give Yiming the government bond. Yiming's going to give me a bunch of cash, right? And the bond functions as collateral basically for the cash loan. And then sort of that loan usually lasts a day or two. And then after that day or two, I can roll that. So then basically I can renew that loan for another day. And the effect of this is basically I take a European government bond, and then I can borrow sort of some large fraction of the value of the bond, right? This is a very large market. In the Euro area, there's around $500 billion of daily turnover in the repo market. In the US, there's something like 3 trillion outstanding. And so the nature of these markets is that because they are sort of mostly fully or over collateralized with government debt, you sort of imagine that these markets should be sort of more stable, less frictional than the sort of pre-crisis situation where you have mostly or a lot of unsecured borrowing, right? The fact that this is secure, this is over collateralized, suggests that basically you should not have to care about counterparty credit risk. Basically sort of repos with different parties should be pretty substitutable as long as they're backed by essentially the same collateral, right? So in Europe, the existing literature has focused basically on the interdealer segment of the repo market. So big dealer banks are going to trade repo with each other. And then so the primary stylized fact that the European repo literature has focused on is basically that even in the interdealer repo market, there seems to be segmentation along the lines of what collateral is used for trading, right? So then the dealers are trading repo loans on relatively competitive exchange markets on e-trading platforms, right? So basically they're trading repo on things that look like limit order books, right? And then the literature has noticed that basically the rates that you get for borrowing against different kinds of collateral are different. So the idea is basically that if you want to borrow and you have a German bond, you're going to get a rate of something like negative 70 basis points. If you want to borrow and you have a French bond, an Italian or Spanish bond, you get something higher. So then you get something like negative 60 or negative 50 basis points. And then this fluctuates somewhat over time. So the literature has noticed that there's some market segmentation in this market. So what we do in this paper is analyze a previously unstudied segment of this European repo market. The European repo market basically has a core periphery structure. Dealers trade repo with each other. But dealers also trade repo with customers, right? If a hedge fund has a bunch of German bonds, it wants to lever these up so it can take a levered bet on these German bonds. It has to borrow a large fraction of the money, and it tends to do so by using repo with dealers. If a money market fund has a bunch of money, it wants to invest that somewhere, tends to do that by sort of depositing that with a dealer, and the dealer gives collateral in return. So basically, the way that repo markets matter for agents other than banks, for other financial market participants, is through the OTC segment of the repo market, right? And then these customers trade with the dealers. These customers cannot directly access these interdealer markets. They trade with the dealers in an OTC manner. They call up a dealer that they have a relationship with, and they have to do repo with the dealer. And then the dealer trades in the interdealer market, right? This market is large. In the Europe, it's around 30% of repo volume. In the US, bilateral repos are something like 50%. And then sort of, it's the only way that a lot of these market participants can actually access the money markets, right? And then the kinds of people who are active in this market are some of the ones that I mentioned. So money market funds, mutual funds, pension funds, insurance companies, so on. This is just a simple breakdown to show basically that the fraction of volume from these two classes of participants, sort of the non-dealer banks, is fairly large and stable throughout this time period of 16 to 18, right? And then so what we're going to do is, for the first time, we're going to use a new data set that allows us to shed light on this segment of the market, right? So then we're going to use the European Central Bank's money market statistical reporting data to study what's going on in the OTC repo market. And the core point we're going to show is that dealers appear to have substantial market power in the OTC segment of the repo market. So when a dealer is trading with other dealers, right? And then the dealer sort of trades with his customer, the dealer has market power over his customer, allowing him to charge different rates. And then this is important because it limits the pass-through efficiency of monetary policy. I'm going to show one plot, which basically is sort of the core plot, which suggests that dealers have some market power. On the left here, I showed you basically the segmentation plot. So the plot that suggests basically that sort of markets for different kinds of collateral are segmented, right? And the evidence here is basically cross-collateral rate dispersion, right? These are trading at different rates, quite large differences in rates in some periods at around 20 basis points. Now, the question we can ask, sorry.
Clarification question.
Yeah.
So I think you refer to the market segmentation as the different rates of the different bonds of Germany, France, but sorry. So there's a in the literature about euro area bonds. These Germany and France, they are considered like safer, and the periphery countries, they are considered the default risk is probably higher. So I'm not sure whether repo market is not exposed to that kind of risk, and then this is kind of like a segmentation of market instead of a different risk characteristic of different bonds.
Thanks, really great question. I think the theory behind why I think people don't think this is pure credit risk is because repos are over collateralized. So sort of the differences should be accounted for by haircut differences, not by rate differences. So if you're sufficiently over collateralized, fluctuations over one day in sort of the value of the bond are not going to lead to such large differences. So I think there is a paper, I forgot exactly by who, that does a calibration, basically sort of taking this seriously and says sort of it's hard to explain sort of the pass-through, sort of the repo rate differences purely based on differences in the safety of the collateral. I think the hypothesis of where the segmentation is coming from is that the repo market serves a function in providing collateral that people can reuse the collateral and, for example, shorting bonds and things like that, right? And then sort of that generates demand pressure for different classes of bonds and can plausibly create differences in rates. So I believe the literature, not exactly the focus of our paper, but the literature believes this is not credit risk, but some kind of collateral demand effect. Does that kind of address your question?
Okay, thanks.
Yeah, thanks. Okay, so again, not exactly the focus of our paper, but the stylized fact is segmentation. To look at market power, we can ask the following question. For the same bond, if we look at a dealer and we look at what the dealer is trading with different customers, right? What rates is a dealer getting in the OTC market when trading exactly the same bond at exactly the same terms, right? So here we basically plot time series of the distribution of OTC repo rates for German bonds, right? And then so the way to read this is that the red line and the blue line are the rates that dealers get, the 75th and 25th percentile of rates that the dealers get when lending against German collateral. Orange line and the green line are the 75th, 25th percentile of rates that the dealer gets when he's borrowing against German collateral. So the two things that I want to highlight here are basically, first, that there's very large dispersion in OTC repo rates for exactly the same bond. So different customers are getting very different rates. There's some customers who presumably are getting a relatively good deal. They're borrowing from the dealer at something like -70, right? There's some customers who have to pay a much higher rate, right? And then likewise on the deposit side, if you're depositing with a dealer, you get anything from something like -70 to -100 basis points, depending on who you are. Second thing to notice is that the dealers are able to lend and borrow at systematically different rates. The dealers get a net interest margin for exactly the same trade on both sides. So the midpoint of the lending transactions is something like 30 bips higher than the midpoint of the borrow transactions, right? And so the idea is by doing exactly the same trade on two different sides, the dealer is able to make a markup, right? And then the next thing to note is the magnitudes of these effects are fairly large, right? So then again, there's a fairly big difference between lending against Italian and Spanish collateral and German collateral of 20 bips, right? But then if you look within the German collateral, the people who are the most favored German customers on the lend side are getting -70. The worst are getting something like -50. So the intra-collateral spreads, the within collateral spreads, are sort of sizable relative to the cross-collateral spreads. And then this is basically our evidence that dealers appear to have market power in the OTC segment of the repo market. Our explanation for what's causing this dispersion is that dealers are able to partially price discriminate, charging different rates to different consumers in these markets, right? Okay, so what do? We're going to construct a simple corporate-free OTC model, right? And the point of this model—
Can I ask a question about the evidence? Do you also observe haircuts on those repo contracts?
Yes, we observe haircuts, yeah. And then we'll talk about how we try and show that sort of. We're going to do something more detailed than this, which is to show that the various different characteristics, what bond it is, what's the haircut, what's the term, so on, don't explain this dispersion in rates. Yeah. Okay. So we're going to construct a model, and the goal of the model is to basically simultaneously be able to talk about this collateral, intra-collateral segmentation, as well as these market power frictions. And then so we're going to show how you can decompose pass-through friction. So the central bank sets a policy rate that passes through the inter-dealer market, and then that passes through to the OTC market and other participants. We're going to construct a model of this pass-through process where basically sort of the deposit facility rate is going to be constrained in its pass-through to the inter-dealer market because of collateral supply and demand, and further constrained in its pass-through to the OTC market using market power. In addition to this sort of stylized evidence that I've shown you purely based on the plots, the model is going to point to basically a test of how we can argue that basically this patterns in the data are indeed explained by market power and not some other force. For example, the loans are just different, or dealers have balance sheet costs or something like this, right? And then the test basically is the following. The model predicts that market power simultaneously introduces three things. It introduces rate dispersion, net interest margins, and pass-through frictions. If market power is indeed causing these three things, what we would expect is basically these are correlated. Kinds of collateral, kinds of trades. The parts of the repo market with high dispersion, high net interest margin should also have low pass-through. And then we test this in the data. The way we test it is that in 2019, the ECB changed the deposit facility rate. So it cut the rate by 10 basis points. We can use this to measure pass-through to different segments of the repo market. And we can basically use this to ask, is it the case that the segments with higher dispersion, higher net interest margins, where we kind of think the dealers have more market power, also have lower pass-through? And then we'll show indeed that it does look like this is the case, that pass-through is lower in segments with higher dispersion, worse rates. So indeed, sort of this prediction of the model seems to be verified. This is a pattern suggesting that it is indeed market power going on here. Okay, why should you care about this? So this matters because market power is a constraint to monetary policy pass-through. When the central bank cuts the deposit facility rate, by 10 basis points. The hedge funds, the money market funds, the mutual funds, the pensions, they're not seeing all of that 10 basis points because the dealers adjust the markups to absorb some of that. How much? So we can quantify how much this limits pass-through. And we estimate basically that it limits pass-through efficiency by something like 20 to 28%. And what does this mean? This means that in a counterfactual world where some of these customers had direct access to these interdealer platforms, could trade repo in the competitive segment of the market, right? This would alleviate this sort of pass-through friction. This is somewhat a real counterfactual because like increasingly some of these market participants are in fact getting access to the interdealer markets through, for example, sponsored repo kinds of programs. The other thing that we'll mention is that sort of the Fed, for example, has a reverse repo facility, which is basically a secured deposit facility, which is available directly to non-banks. This also is a constraint on market power and can improve pass-through because of the fact that when a customer can directly trade repo with the Fed, this disciplines the rates that the customer's dealers can charge it, right? And we show in these OTC search models, in fact, there's an effect, which is that facilities like the reverse repo facility can affect market outcomes, even if there's no take-up of the facility. And the reason is because the RRP serves as a price floor, which affects market outcomes through a bargaining channel. Even if I don't use the Fed's facility, I can go to my dealer and tell my dealer, the Fed is offering me this rate. You have to beat this rate. And then so we're going to talk, and then that's going to change the rates that the dealer can charge. So we're going to talk briefly about how this effect works. Okay, so then our paper fits into the literature, basically a couple of literatures. Broadly speaking, we fit into the literature on money market frictions and policy rate pass-through. So there are some papers from Beck and Clay talking about similar market power forces in a paper by Duffy and Krishnamurthy. The collateral segmentation aspect of the paper builds on the literature on special repo rates, which has also basically been the focus of the European repo market literature so far. So this is going to play an important role. We're going to account for this. But the main thing we're going to focus on is the OTC segment of this market and market power in the OTC segment. So our OTC model is going to basically build on the OTC literature, which is too large to go through in detail. And then sort of we also border on and contribute to some of the ideas in the literature on European repo markets. That's basically where we fit in the literature. Any questions on the intro or? Okay, going forward. So I'll talk about stylized facts, the model, how we test the model, and then our policy counterfactuals. So the data set we use is the money market statistical reporting data set of the ECB. So then this has, so to give you a sense of what data the literature uses, the literature is basically using data from interdealer platforms. They can see trades between dealers, right? And then so the MMSR data, in contrast, surveys 38 major dealer banks on all repo transactions they're making in the interdealer market, as well as OTC transactions they're making with their customers, right? So this is the first microdata in the literature to our knowledge on European OTC repo markets, which constitute around 30% of total repo volume. And then we observe trade level data, the date of the trade, the specific ISIN of the collateral, the interest rate of the trade, the maturity and haircut of the trade. We observe who the dealer is. We observe some IDs of counterparties. And for some counterparties, we at least observe the sector and location. So think of sector basically as, are you a money market fund, insurance company, or a pension fund? And then location is country. We're going to do some slight sample restrictions. We are going to restrict attention in this paper to the relatively large segments of the market. So German, French, Italian, and Spanish government bond repo. We're going to restrict special collateral repo for overnight, same next and tomorrow next term. So basically 1 day repos of T+0, T+1, T+2. And most of the volume, I think over 80%, is concentrated in these segments in our data. And our data spans March 2017 to March 2020. Okay, I basically mentioned, so a few words on market structure before I talk about rates. So I basically mentioned the structure of this market is sort of a core periphery structure, which is quite common basically in these dealers kinds of markets, right? And then the trading mechanisms used also basically differ. The dealers trade on what we might think is a relatively efficient trading technology. They trade on e-trading platforms. Their trades are centrally cleared. And you would expect this segment of the market to be relatively efficient. The periphery is organized in an OTC manner. So formally, customers are going to basically, they have relationships with dealers, and then they sort of trade repo in an OTC manner. You might ask, basically, in practice, if a customer is connected to enough dealers, maybe they can basically trade off the dealers' quotes against each other and then get pretty good rates anyways, right? Well, we can simply ask, how much is this happening in the data, right? We can ask, how much do we observe customers basically being able to trade repo with different dealers? And that would basically determine how much they can, in practice, have the dealers compete with each other. What we show in the data is that the periphery of this network is pretty sparsely connected. So the median customer in our data set throughout the entire time period of our data is trading with one dealer. A 75th percentile customer is trading with two dealers. So it seems indeed that this is an OTC market where sort of there is relatively sparse connectivity in the OTC segment. Most people in the data, we never see them trading with very many dealers, which is just sort of descriptive evidence suggesting that dealers could have market power in this segment. Okay, rate dispersion. So I showed you this plot. I won't go through it too much in detail again, but the basic idea here is that there's substantial dispersion in repo rates in the OTC segment of the market. And this dispersion is large relative to, for example, the difference between rates of different kinds of collateral. Dealers are also able to make a net interest margin. So then some more descriptive evidence suggesting this is indeed market power. We can ask basically who is getting the good rates and who is getting the bad rates in this plot, right? And what we find is the kind of customers you would expect the dealers to have less market power over are the customers who are getting the better rates. So basically, customers who trade larger volumes get better rates. Customers who trade, who have more connections to different dealers are getting better rates, right? So this is kind of suggestive evidence that the customers are sort of, the dealers are able to basically price discriminate. The customers who are the more valuable clients who have sort of more options to trade with different dealers are getting better rates. Now, a simple question here might be, why doesn't everyone just connect to a lot of dealers? What we find is basically, so this is in the paper, that sort of it's volume with a specific dealer that affects your rate. So the idea is, what would discipline your ability to just connect to 10 dealers is that if you connect to 10 dealers, there's sort of a higher effect of being able to have the dealers compete against each other. But the smaller volume you do with each dealer, you would have smaller volume with each dealer, which are in our data is associated with worse rates. That's just some descriptive evidence that suggests that this looks like market power. Okay, so a question is basically, how do we know that this dispersion is not just because the loans are different, right? And then there's many things about the loans that could affect the rates. For example, what exactly is the bond being used here? What's the haircut? What's the, and factors like this. So we're gonna do an exercise that suggests that basically this dispersion is not explained by characteristics. How are we gonna do that? We can purge repo rates of predictable variation simply by running a regression of repo rates on a vector of characteristics. The precise ISIN of the collateral, the haircut, the loan maturity. The residual here is rate variation, which is not explainable by these characteristics, right? And then what we find is basically that this reduces somewhat the dispersion that we see, but not by very much. So the left plot is the German rate quantile plot that I showed you on the last slide. The right plot is what happens when we take out all this predictable variation, and then we plot the residual. And the basic stylized fact is that there's still dispersion, and there's still net interest margins. So neither the dispersion nor dealers' net interest margins are explained away by characteristics of loans. Sort of the IQR decreases somewhat from 14 to 10, 12 to 8, but sort of there is still substantial dispersion and substantial net interest margins after we account for predictable variation. Okay, so that's basically our stylized facts. Now we're going to construct a simple model to try and explain these stylized facts. The basic overview of the model is the following. We want to construct a model of pass-through from the central bank's deposit facility rate, where dealers can deposit money and get a certain rate, into the interdealer market, and then into the customer segment of the repo market, right? So we construct a simple kind of core periphery network, a core periphery model with these two components, pass through in the interdealer market and then pass through into the customer market, right? So the way the model works is as follows. There's an interdealer market, which is basically a bunch of dealers have excess funds, the blue ones. A bunch of dealers want to borrow funds. That's the green ones. The dealers with excess funds have two choices. They can put money directly into the deposit facility at the central bank, or they can trade repo. The dealers who want to borrow money have to borrow from the repo market. In addition to this, so equilibrium in this market is going to pin down the interdealer repo rate, basically. And then sort of imperfect substitution of these dealers, because between the unsecured deposit rate and then the secured repo rate is going to mean that the pass-through from this to this is not perfect. Now, the dealers can then trade with their customers. So then in the customer segment, there's lenders and borrowers. Some people want to lend to the dealer, money market funds, for example. Some people want to borrow from the dealer. And then each dealer's marginal cost for making these trades in our model is basically the interdealer repo rate, because of the fact that when a dealer, for example, takes money from a lender, the dealer can just put that in the interdealer market. When the dealer needs to lend to a borrower, the dealer can simply turn around and then borrow money from the interdealer market. So that's what the dealer does. And because this is an OTC market, the dealer can charge a spread in our model on these trades. So then the dealer can charge a different price to these borrowers than the interdealer repo rate in the interdealer market. And then so this is a simple conceptual framework, basically, that allows us to decompose sort of frictions in these markets into these two layers, the sort of market segmentation, collateral scarcity layer, the fact that the deposit facility is not a perfect substitute for the repo market is the first friction. And the second friction, which we focus on basically, is this OTC friction. Okay, so the interdealer market, I won't spend too much time on. It's relatively standard. It's a relatively standard, basically, model of special repo rates. And the idea is basically that there's a supply and demand for interdealer repo lending. And then, as I mentioned, there's lending dealers and borrowing dealers. And then the key point is that lending dealers find repo and unsecured deposits to be imperfect substitutes. Likewise, borrowing dealers have a partially elastic supply curve for or demand curve for borrowing repo. And as a result, basically, this implies that the pass-through of deposit facility rates to interdealer repo rates is imperfect. For a kind of supply-demand intuition, when sort of the supply curve shifts out, the price is going to shift not entirely one for one. So I'll leave this to the paper, as this is relatively standard. In the OTC market, what we assume is basically that dealers can trade with their customers. Dealers' costs end up being the cost on the interdealer platform. So because a dealer can turn around in our model and then trade on the interdealer platform at exactly what we're going to call RCCP, the central counterparty repo rate. What we're going to assume is Nash bargaining. We're going to assume a simple model of basically price discrimination in the interdealer market, which is Nash bargaining. So basically, we're going to assume that the marginal cost of the dealer for doing this trade is the interdealer repo rate. However, the trade actually happens at a rate which is the interdealer repo rate plus for a depositor a markdown, which depends on basically how much lower the depositor's value is than the interdealer repo rate, right? And then there's randomness in how much the customers are willing to pay for repo lending. And there's randomness in the bargaining power that customers have with the dealer. So some customers are willing to pay more and less. Some customers are better at negotiating rates with their dealers. So another way, of course, to look at this is basically that the repo rate is going to be an average, a weighted average of the dealer's marginal cost, which is the interdealer repo rate, and the customer's willingness to pay. So this rationalizes the stylized facts we observe in the data, right? And the reason is basically because if we assume that basically repo rates are an average of the dealer's marginal cost and customers' willingness to pay, there's going to be rate dispersion because different customers have different willingness to pay. Different customers have different bargaining power. Both of these are going to generate different rates for the same, observably same trades, right? It's going to generate net interest margins, because on the borrow side, dealers are going to be able to lend at systematically higher rates than their marginal cost and borrow at systematically lower rates than their marginal cost, right? And then the other thing this implies is that market power is going to limit pass-through, right? And the idea is basically that if you differentiate this with respect to dealer's marginal cost, a 10 basis point shift in the interdealer repo rate does not cause a 1-for-1 shift in the rates that customers see, right? And then the higher the market power of the dealer, the lower this pass-through. So then this is basically how the model rationalizes the rate dispersion and net interest margins we see in the data. As I mentioned, the model also generates testable predictions. If indeed dispersion, net interest margins, and pass-through are all driven by market power, these three should be correlated, right? So places which look like they have high market power in terms of dispersion, in terms of net interest margins, should also have lower pass-through. And in particular, we can test two predictions in the data. The first is higher rate dispersion is going to be associated with lower pass-through of policy rates. The second prediction is that if we look at customers and we look at the customers who are getting worse rates, these look like the customers who the dealer has more market power over, right? And we would also expect lower pass-through of rate changes for these customers. And the identifying assumption here is basically that changes in other factors that might affect rates due to the policy rate shock we're going to use to measure pass-through are not correlated with ex-ante market power of the dealer. Okay, so the way we can estimate pass-through is nicely, there is a rate change, a deposit facility rate change towards the end of 2019. And then so here's a plot of the interdealer repo rates around 2019. And you can see that there was a sharp change. So the deposit facility rate dropped from -40 to -50. You can see a sharp drop of all of these rates before and after the deposit facility rate change. So we're going to be able to measure pass-through of the deposit facility into the interdealer market and then into the customer market in a relatively simple manner. First of all, our model suggests that you can decompose pass-through in the following way. The pass-through of interdealer repo rates into the customer the pass-through of deposit facility rates into the customer segment of the market can be decomposed into two things. So basically, the pass-through of deposit facility rates into the interdealer segment times the pass-through of interdealer rates into the customer segment, right? And then I'll leave this to the paper, but we can basically, the model shows that you can sort of decompose this change into these two components, one of which is segmentation, the other of which is market power. Practically measuring pass-through is fairly simple. We find for any segment in the data, the pre and post rate, take the difference, divide that by the change in the deposit facility rate. So 10 basis points, right? And it's like for a 10 basis point shift in the deposit facility rate, how much did rates in this segment of the market change? Yeah. Okay, I am running a bit short on time. I'm going to go quickly through the predictions. But the basic idea is let's look at the collateral types which have higher rate dispersion prior to the rate change. And then as the model predicts, pass-through is lower for collateral types with higher rate dispersion. Effect is fairly big. For the most dispersed, you have around 40% pass-through. For the least dispersed, you have basically perfect pass-through. And then the second prediction, I will skip this for reasons of time, but this holds up in a regression also, with the exception of Spanish collateral, effect is not significant. Second prediction is that the customers who are getting worse rates also have lower pass-through. And then we simply regress pass-through for customers on the rate that they're getting in the pre-period. And indeed, the customers who are getting the worst rates are also getting lower pass-through. We'll note briefly that there's two tests, right? Because we have borrowing and lending customers. So the theory predicts that the borrowers who are getting when the dealer lends to customers at high rates, pass-through should be lower. When the dealer borrows from customers at low rates, pass-through should be lower. And sort of both of these predictions are verified in the data. Okay, I am 1 minute away from done. I'll mention briefly the counterfactuals that we do. So using the model, we can basically ask quantitatively, right? The point is basically that market power frictions in the OTC market limit pass-through. We can simply ask how much, right? And then we quantify that under our estimates, pass-through efficiency is impeded by around 20 to 28% by market power in the OTC market. And what this basically means is that in a counterfactual world where all of the customers could access the interdealer market directly, we could disintermediate the dealers directly, we would increase pass-through by around 20 to 28%. It would not be perfect because of the fact that the repo market and deposit facility are not perfect substitutes, but sort of we would improve pass-through efficiency by around by a substantial amount. Finally, I'll briefly mention that in these OTC markets, right, if you give customers an outside option, even if that outside option is non-binding, and it can affect market outcomes through this bargaining channel. So the idea here is pretty simple. It's just that suppose that you set a deposit facility where the OTC customer can get access to deposits at a certain rate, right? If the rate is binding, that's obviously going to influence market outcomes. But in markets with search frictions, if you give the customer an option they can use to negotiate with dealers, that sort of exerts competitive pressure on OTC market rates and can also influence outcomes. So this is basically a simple rationalization of why it is that it could be useful for the central bank to give these kinds of deposit facilities, these kinds of deposit facilities available to customers. It sort of disciplines the market power of dealers. And this can be true even if we never actually observe these customers using these facilities in market equilibrium. Okay, so those are our two counterfactuals. I'm already somewhat over time, but just to briefly conclude, we have a new data set which basically allows us to, for the first time, shed light on what's going on in the OTC segment of the European repo market. What we see is basically there's evidence of substantial market power. So we write a model which allows us to basically decompose pass-through frictions into basically collateral scarcity and market segmentation, as well as market power. We verify the model's predictions, and then we sort of talk about the implications for policy. So how much is this market power impeding pass-through? And what does this imply for things like the RRP, non-binding floors that the Federal Reserve and that central banks are imposing in these markets? Okay, thanks a lot. Sorry for going slightly over time.
Our discussant is Adam Copeland.
All right, thanks. I'm sharing my screen. Oh, sorry, I have to allow this to work. Oh, crap. Oh, I'm so sorry. I didn't realize that my computer is making sure that I can actually share my screen with you.
Maybe I'll take the chance. So take your time, Adam. So can I? Oh, yeah, okay. It's already here.
Is it working?
Yeah.
Okay. Can you see my screen?
Yeah.
Okay. Whew. Sorry, I have a work laptop, and every now and then they throw me curveballs. Okay, so thank you for asking me to discuss this paper. I really enjoyed reading it. I also want to say, in case I forget, I think there's going to be a huge research agenda that these guys can use to use this data set. So I'm really looking forward to seeing, the other papers they sort of write. I work for the New York Fed, so I have to say these are my own views, not those of the New York Fed or the Federal Reserve System. Okay, so I'm going to start with a summary of a paper and then sort of just go into two or three comments. So I sort of see the paper as having these three parts: data, model, empirics. And so first, I should just emphasize again the data. It's just really beautiful data set that they have. It's transaction level repo data from like 38 firms, which are the main intermediaries in Europe. Just the kind of things they can see exactly what securities were delivered. They can see the interest rate, which is often called the price of a repo, the principal amount, which is the cash. They can see the term, and they can track the dealer and the customer. And so my sense is, I don't think they know exactly who the customer is. Maybe they do, but they can see the same customer over time, like in a panel data set. So you can sort of control for that customer over time. And they have some very general characteristics of the customer, like what segment it is in the economy and stuff like that. They know where the trade is executed, right? So was it done on a platform, or was it a customer like CCP or non-CCP? So I just want to emphasize, this detail, this level of detail and this comprehensive size is really novel. So like in the US, for instance, we have detailed data that's not comprehensive. We have comprehensive data, which is not detailed. So these guys have like both, right? Which is great. One thing they also can see is they can see when people execute these trades, they sort of know, like when you execute the trade, do you agree on what security needs to be delivered? Or are you just agreeing that, there should be like a Spanish bond, like some sort of class, right? So this is going to kind of be important about like what's decided at the time of execution. And what they chose to do is they just choose to focus on the first set, which I call specific repo trades, where when you execute the trade, you know exactly what security you're going to get. You don't, rather than just saying, anything in the class, I know exactly what I'm going to get. Yeah, and I think they do it for the empirical work, but I'll circle back to that at the end. All right, so then they have this model. So I don't want to, de-emphasize. There's all this part in the paper where they do these, summary stats, where they just describe stylized facts, and that stuff is really, really great. All right, and then they say, okay, well, how do we make a sense of all the patterns in the data? And they say, well, the framework, or our view of it is going to be sort of this model, and it's a nice model, pretty simple model. They say, like, just take a single security being traded. You have these two markets that the dealers can both access. One's an interdealer, one's for their customers. And the dealers basically like a price taker in the interdealer portion, get this rate for the security or for the cash against the security. And then you have this idea where the dealer and the customers are trading, and they use this sort of bilateral setup, right? Where you meet a customer and you have a bilateral trade. There's going to be gains from trade, and then because they're an Nash bargaining thing, you just have the sense about like, well, how are you going to split the gains from trade, right? Who gets, is it half-half? Is it one person gets all the gains from trade, and go on. So this is a theta parameter in the model. And then, of course, the dealer also has an option to invest cash at the ECB in its deposit facility, DFR or DRF. So what's really nice about this model, about this framework, is that you can sort of solve and get this equilibrium rate. So you can sort of see how all the rates in these two segments of the market are connected. And you've got customers who are lending cash against collateral and customers who are sort of providing securities against collateral. So there's really nice, elegant framework about how these rates are all interconnected along with the ECB rate. And then you can do all these nice comparative statics. Okay, so they do all these nice comparative statics. They show you how the model works, how these things are connected, and they emphasize in the model section that these two predictions, which are these correlations between these two data objects, like it's like correlations between the dispersions of rates and things like that. I just want to sort of say, for now, like really both these claims rely upon the fact that there's this prediction in the model that the connection between rates in the CCP versus the OTC really depend upon the bargaining power of the dealer. Right, so these are these derivatives here. So RD is the price that a customer as a depositor gets, from the dealer, and this other rate is the interdealer market. So they're sort of saying, look, changes in the CCP feed through to the OTC market just depend completely upon the bargaining power of the dealer. Right, so the dealer has zero bargaining power, theta equals 0, and there's a one-to-one pass-through. So you can sort of see already like how the model is going to sort of say, look, we're going to get these, if you see incomplete pass-through in the data, then you can the model is going to tell you, well, really that's going to be driven by bargaining power from the dealer. When the dealer has more and more bargaining power, then it has a larger and larger, there's less and less pass-through, okay, of these rates. And that's going to be sort of like, I see that sort of as a key part of the model and a key contribution to how they're going to think about the data. Okay. So now the empirics, I'm not going to do justice, but I figured Anthony was going to present it pretty well. But I sort of view the empirics as like, well, do these predictions hold in the data, right? Like how seriously should we take this model? How well does it work? And so the way they do it, right? So remember they have this comparative static about how a change. Basically, they're trying to look at how changes in an exogenous change in the CCP, how does it change to cause changes in the OTC market? And so they do. They say, oh, look, in our data we have this large like macro change in the CCP interdealer price, which is provided by sort of the ECB, right? So you can sort of think this is like, so they're going to sort of look at that, how this exogenous or this large systematic change in prices sort of feeds through to these different segments. Now there's this like big empirical hurdle, right? Because the model they put down, although very elegant, is also very like, I don't know, it had a lot of assumptions, right? There's like a single security, there's like a single customer meeting with the dealer. There are all these elements to the model that you're like, well, and that don't hold in the data. You got tons of customers, you got tons of securities. And so this is really where the detailed data really shows its strength, right? So they're basically able to control for all these different things to provide a convincing argument that they're able to sort of really test the comparative static that the model predicts. All right. And the predictions are sort of largely affirmed in the data, is what I'm sort of saying. So the predictions that they expect to hold, you sort of see in the data. And the takeaway that I sort of get, and I'll come back to this again, is that it looks really like dealers have bargaining power in their trades with customers. Okay. All right. So now let me feed into my comments. All right. So this is not a big comment. This is a little. So for me, when I read the paper, the market power word really actually distracted me. All right. So I'm an IO economist. For me, market power has this really traditional meaning about you have a firm setting like market-wide prices, and it's really sort of trying to like maybe reduced output to sort of increase its profits, right? So I see sort of market power as being a word applied to sort of very different kinds of models, right? That what you have here is you have a model of, in the OTC part, of bilateral trade, right? And these guys are not, bargaining, Nash bargaining over the gains from trade. And just because the dealer doesn't have any bargaining power, just because the dealer has some bargaining power, I don't call that market power. So that I found that distracting. I feel like maybe that was just me, and that also because I come out of IO. I really think bargaining power is more appropriate, and I find it's a useful tool to remind people of the kind of model that you're sort of using to look at the data. Okay, so that was the thing. And then of course, I think one thing too that sets up is once you start thinking about bargaining power, you sort of say, well, but dealers have bargaining power. I think that sort of begs the question about like, well, what is actually behind the bargaining power? Like, what is it that causes the dealers to have this sort of these gains from trade that they're allowed to take, a non-zero amount of that, like search costs, I know it's entry costs. And so I was curious whether, maybe not for this paper, but I was just sort of curious, like, well, do you have some sense, given all the rich detailed data that you have, about what might be driving the dealer's bargaining power? So just throwing it out there, maybe for future work. This is the second comment. So once again, I understood the main takeaway to be like, dealers have bargaining power when trading to customers. And I kind of felt like, well, can't the authors just say more about this, all right, more about dealer behavior? So I was sort of getting that the test you guys are having these two thetas. So theta D is when the dealer is, I think, borrowing cash, and theta B is when it's lending cash. Or I got confused, but that's why you have these two parameters. It might be nice to know like how much bargaining power they have, right? I kind of feel like, once again, when you're in this setup where you have bilateral trade, I don't think it's unusual that they have non-zero bargaining power. And so I was just curious whether you could sort of say more about like, well, what is it? Is it half? Is it closer to one? Like, sort of go down that road more. And there's a second thing where I was like, so you had like two sentences in the paper, you had a sentence in your slides, but I felt like in the paper you didn't really talk about this as well. There's lots of other explanations out there about differences in pricing between OTC and CCP, right? So I was always struck by this question. I was like, well, why are you looking at these like complicated correlations between like dispersion and stuff like that? If you just care about bargaining power, then your model predicts that basically any sort of pass-through, any sort of incomplete pass-through, right? This is what the equations would be consistent with bargaining power. And so this is what I really think you guys did, but it didn't come out when I read it to the paper, is that there's actually like a set of like, N models that would predict incomplete pass-through. Like you had balance sheet costs or you had other stuff. And I think what you're really trying to say is that these other reasons don't explain the correlations that you see in the data, right? And that doesn't come through in the paper. Like it's just a couple, and I was, so I think I missed, basically, when I read this paper, I think I missed a whole bunch of interesting work that you guys have done, but why you arrived at your particular correlations and how these correlations rule out other stuff. And I just think that should be in the paper somehow, right? Like, so you say a couple of times, like, no, balance sheet costs can't explain this. Okay, but I don't see that anywhere in the paper, and I didn't take the time to derive that on my on my own. Okay, so I think right now you're sort of doing yourself an injustice. I think you really should make this point better. Okay, I think that's sort of what all that is there. Okay, and this is the last one. I've actually already told the authors this, but I'll just sort of say it again. And I'm sorry that's probably your fact. So one thing I sort of saw is that the authors filter the data out and drop general collateral trades. And I believe it's done because on their empirical section, they want to sort of control for all these things. Like, like the model, once again, is very simple. It's one, So I believe that they want to have like fixed effects for collateral in their empirical regressions, and they could do that when they had repo-specific trades. And for general collateral, I felt my sense is they couldn't do it, or they're still working on it. All right, so I just want to, I told them so already when I said, but there's a cost to going to specific repos, right? And the cost is that when people negotiate specific repos, they have different motivations for doing it. One is they're trying to get funding, which I believe is how their model is sort of motivated. But other times they're actually trying to get specific collateral sort of onto their balance sheet, like for hedging purposes, some other stuff. And I think, and I didn't, once again, I didn't go through this methodically, but if I was a referee, for instance, I would. I think what happens is that if a bunch of your trades that you're examining empirically are actually done for non-funding reasons, if you want to do hedging, I feel like it makes your empirical work even harder, right? Because what happens is that if you're sort of trying to acquire specific collateral to hedge against like interest rate risk and stuff like that, then when the ECB does start change in the deposit rate facility, I believe it's going to have like a whole set of variation on the rates you sort of see for these repos. Like it's not going to be like a simple sort of shift in how people negotiate these rates. So in particular, I don't think, if I go back to empirical exercise, we say where I'm trying to test this prediction, holding fixed all this stuff, I no longer think fixed effects per ISIN, may not work. It may work, but it may not work. All right, and I feel like, so if you're going to continue this route of sort of using specific repos, then maybe you want to talk about this a little bit more. Maybe you thought this through, but maybe have a little paragraph or something in the appendix. I know that sort of says, why this still works. Nevertheless, I think it's feasible. If it's feasible, I think filtering, like for looking at funding repos by themselves, would be an easier empirical exercise, and I think it would improve, convince the readers that about your main result, right, which is supposed to be about pass-through. All right, so those are my 3 main comments. Once again, I just want to circle back and say I think this is a really interesting question. I think I sort of like the model, I like the empirical work. I think my main thing is I feel like you guys got all the stuff, but it's just not in the paper, and I wasn't able to appreciate the paper to its fullest extent, right? Because I feel like these really important points. Yeah, I couldn't connect the dots about all the stuff that you've done. So that's all I have to say. Thank you very much, and I hope this is helpful.
Okay, thank you, Adam. Anthony, do you want to answer some comments briefly?
Great, yeah. First of all, thanks a lot for the really great discussion. It's going to be really helpful in revising. Market power, so on your 3 main comments, market power, yeah, we agree. Bargaining power might have been a better word there. I don't have a perfect response for that. We'll have to think a bit about sort of how to frame that. As for what's going on there story-wise, so then we have some evidence, some data evidence, and some sort of narrative evidence of sort of why does this market work the way it does. So the narrative evidence is basically that sort of people don't trade with all the dealers because there appears to be some kind of, for example, if you're a hedge fund, you have 1 or a few prime brokers, and if you try to have 20 prime brokers, your prime brokers fire you. So the prime brokers seem to demand a minimum kind of scale, which kind of makes sense, I guess, in the sense that their costs seem like largely fixed costs for adding a client. So sort of there would be some limit to how many clients a customer can connect to. So if this were happening, what we would expect in the data is some sort of patterns like you would have a limited number of connections. The people with higher volume and the people who are in a better position to connect to more dealers are going to get better rates. And then we see some evidence of that in the data. And we have a simple model in the appendix to basically just sort of tell this story of, suppose you have to pay some cost to connect to dealers, right? And what's going to happen is you're going to connect to more dealers if you trade higher volumes and thus be able to negotiate better rates. So then that's kind of our narrative. That's kind of the combination of like data and narrative of what we think, like why we think this market looks the way it does. Yeah. As for the takeaways and the pass-through point, I think you totally pinned down what we were trying to do, and we should do that better in the paper, which is the correlational analysis sort of is a model testing component basically to say, we think this is what's happening in the data as opposed to other models because of these. And then sort of in the counterfactual, we're basically using this pass-through, like basically sort of, if this is the market power friction to pass-through, if you remove that, you would get this much out. I think it's really helpful that that isn't coming through super clearly, and we should do a better job in the paper of having that come through. The last point for SCGC, I think one of the difficulties we're facing here is just that it seems to us like it's not so easy to cleanly define SCGC for dealer customer trades. And the problem we're facing is that on the interdealer platforms, it's pretty simple because it's either SC on the platform or GC on the trading platform. There are nicely defined GC baskets on the platform. And it seems like these baskets don't correspond one-to-one to what the dealers are doing with their customers. So we think we can probably do something about this, and we're sort of working through it, but that's kind of the main difficulty we're facing. But we totally agree this is quite like, we could be doing better on that, and that's something we're working on right now. But thanks a lot for the really great comments. And it's going to be really helpful, and especially on the sort of, we should do a much better job on framing and sort of tying together like how our results are kind of trying to tell this story. So thanks a lot for it.
All right, we'll open the floor for a few questions. Is there any question from the audience? If not, I have a question. So Anthony, because it's a repo contract, I understand you're focusing on the bargaining power, assuming there's abundant sort of collateral to secure the loan. Now, but you do use this. You mentioned like there's some measure of scarcity of collateral. Then I would imagine when the collateral is more scarce, maybe dealers will face a trade-off, like between posting more collateral or charging a higher interest rate. Is that something you can take care of in your empirical analysis?
That's actually a very interesting point. Or I guess, see if I'm interpreting your point right, which is in a scarce collateral environment, you could actually adjust haircuts to sort of squeeze more collateral out of collateral. Is that sort of the point?
When it's more scarce, maybe it's more costly to post more charge a higher haircut instead of a higher maybe interest rate.
So we had never thought of it that way, because the way we had thought about it is sort of the indivisibility means that sort of like juicing an extra percent, or so, like, because in practice, the haircut variations are, you're thinking like 95, 99%, right? So you're juicing out an extra like 2 or 3% more collateral from each bond in a collateral scarce environment. So quantitatively, that seems like it would be small, if you see what I'm saying, but I'm not sure about that. I have never heard that story before. It seems potentially interesting if it's that potentially in a collateral scarce environment, you make the collateral go further by doing that. So one thing I should say is that I think the normal way people think about collateral scarce environments is that sort of people want more collateral, demand collateral because they want to, for example, short the bond, right? And then the trade is driven more by the demand for collateral than the demand for cash. And then sort of you do actually see an effect like you're talking about, which is that sort of haircuts change and rates change, but reflecting the fact basically that the people who are buying the collateral are willing to pay good terms to get the collateral. So for example, they're willing to even post more cash than collateral. But it's driven not so much by, I guess, in a sense, it's driven basically by the fact that sort of the trade is, I'm trying to buy a bond from you so I can short it in the repo market. So that seems, I'm not sure if I totally understand your point, but I think that seems a bit different from the force you're talking about. But I never thought of the force you're talking about. I should think more about that. I don't have a great answer.
Maybe I'll quickly add to that. So I echo and Anthony, and I agree with you in theory that, this should respond, right? So if there's really collateral scarcity, then the volume of, or the amount of over collateralization should, theoretically respond as much as prices do. But I think in the data, one thing we do see is that, collateral is just very sticky, right? They're not as substitutable with rates as we would likely want to observe. And so, and in the data, over the time period, we should have some variation in scarcity. So maybe empirically, the amount of collateral per loan is just not a margin that these guys are adjusting on. But I think in theory, I'm fully with you that this rational agents should be able to adjust on both margins. That's an interesting point.
So do you mean the haircut is sticky?
Haircuts are pretty sticky in practice.
Yeah.
Across time, yeah.
All right, thank you. Okay, we are right on time. So we move on to the next speaker. Our next speaker is Lian Shi.
Yeah, so I will chair the session. So the next paper will be on fiscal rules and will be talked by Lian from EIEF. And the discussion will be Manuel Amador from Minneapolis Fed and University of Minnesota. So Lian is a very energetic young researcher on many grounds, including labor market, asset market, and fiscal policy. And Manuel is really a giant in sovereign default. I'm sure he will give us a lot of insight today. So Lian, you have the floor now.
Thanks very much for including our paper, and thanks to Manuel for agreeing to discuss on this paper. So this is joint work with Chiara Felli and Facundo Piguelian. And in this paper, we look into the issue that governments have a tendency to overspend and overaccumulate debt. So the commonly accepted reason that give rise to this overspending bias is rooted in political economy due to political turnover that the incumbent government might underweight future spending, creating an incentive to overspend. Alternative to this political economy friction is a behavioral one that government might exhibit preferences that are hyperbolic, so creating some sort of present bias, and fiscal rules that constrain government spending is key to ameliorating inefficient outcomes. And in designing the optimal fiscal rule, the trade-off at concern is the commitment versus flexibility that we do want to allow governments to have some discretion to spend and to respond to shocks to some spending needs. But in order to curtail overspending, we wanted to set some rules. So it's this trade-off between commitment and versus flexibility literature that we are building on. And in the existing theoretical results that assuming away the possibility of sovereign default, the prescriptions that only about spending limits or deficit limits. For example, the Maastricht Treaty would put a limit on fiscal deficit within 3% of GDP. However, default risk is real and important. For example, if we look at European sovereign debt, their borrowing costs differ across countries and also over time, suggesting their respective differences in default risk. And in addition, debt sustainability is becoming an increasingly important issue as debt piles up in many developed countries. So the question we pose here is, what kind of rules would be effective to deal with inefficient debt accumulation when default is possible? Do we need some kind of default rules constraining government's default decision? Would debt limits be optimal? For example, limiting debt within 60% of GDP? And what is the interaction between default policies and deficit limits? So to address these questions, we first developed a model incorporating the frictions leading to spending bias and default choices. So naturally, we need a fully dynamic model to think about debt accumulation and sovereign default. And there is no off-the-shelf model readily available for this purpose. And there are many tractability issues at concern. So to overcome these issues, we set our model economy in continuous time. And there are two key features in the model. There are shocks to the taste for government spending resulting from political turnover. And the taste types are private information. So we do want to give the government some discretion to respond to these shocks. However, governments are also present biased, so giving rise to the need to set some rules. So the model is theoretically tractable and rich enough for quantitative analysis, which we do in this paper. So for today, I'm mostly going to focus on the theoretical characterization of the jointly optimal fiscal rules and default rules. So what do we find? We find that many possible regimes can arise depending on the specific economic environment. And we highlight 4 key economic primitives leading to very different shapes of optimal policy. The first one is the severity of spending bias and the frequency of political turnover. How stable is the taste for spending needs, and also the heterogeneity, and finally the cost of default. So as a preview, the optimal spending rules are also in the form of deficit limits akin to the literature without default risk, but in contrast to a fixed level of discretion in the literature. When default risk is a possibility, you want to set debt-dependent fiscal limits. So often when the government accumulates debt, you wanted to put more constraints on their spending limit to give them less discretion. But it's also possible that the reverse case happens, that when there are disciplines coming from the market by charging higher interest rates, that can lead to actually an optimal, it could be optimal to give more discretion or completely eliminating the needs to setting any fiscal limits. And in terms of the default rules, it's going to be a combination of some kind of debt limits and restricted default. So it could be optimal to forbid the government to default at low levels of debt, and optimal to force them to default at high levels of debt. And we show 2 different regimes depending on the severity of the spending bias that we actually wanted to forbid or mandate default. So now let's jump into the model. So as mentioned earlier, it's the continuous time model, and the agents discount the future at rate rho. And there's an incumbent government with asset position A and receives tax revenue tau, decides how much to spend G. So if the asset position is negative, the government is in debt. And the government has preference for spending. So the flow utility value from spending amount G is of this amount. And here theta is the taste for spending. If theta is high, there is a high spending need. And there is going to be a political turnover event occurring at rate lambda. In that event, the incumbent government loses power to a successor government. And the new government would be drawing a new taste theta for spending, which is IID, and normalized to a mean of 1. And the governments are present biased, so they value future spending by future governments when they're no longer in power by only a factor of beta. So beta can capture some sort of disagreement or polarization among the different parties. And to introduce sovereign default, at any point the government can default on its debt obligations. And upon default, they're going to be excluded from financial markets. And the cost is going to be that in financial autarky, their tax revenue is reduced by a factor kappa. And they can gain access to financial market at rate 5. So we assume upon returning to the financial market, their previously defaulted debt is fully discharged, and they return with an asset position of 0. So an allocation in our economy specifies the spending decisions, G, for each type and at all asset levels, as well as the default decisions denoted by delta here. So it's a binary decision variable with one capturing the decision to default. To close the model, there are a continuum of competitive risk-neutral lenders facing an exogenous risk-free rate, RF, which is sufficiently low to ensure that the problem is well defined. And the interest rate faced by a government with asset position A is going to adjust for the expected default probability. So on top of the risk-free rate, the interest rate reflects the expected default probability, and correspondingly, the asset or debt accumulation is going to follow this process on adjusting for the return on the savings or on the debt payment and the tax revenue and how much the government is spending. So here, why does the, so this is not an assumption that the interest rate follows this form. It's actually an equilibrium result. So in theory, the lenders can observe action. So we're going to introduce private information on the types, but the lenders can observe actions of the government expenditure and recover their true type. But they are not going to condition the interest rate on the specific type, because here we are setting, we're in a continuous time where the asset position of the government evolves smoothly, and the interest rates can adjust instantaneously. So imagine that if a government is on the verge of defaulting, the lenders are not going to be willing to lend an extra amount, knowing that it's going to be for sure defaulted. Or if they are willing, they would need to charge an infinitely high interest rate, in which case the government would not want it to borrow at all. So here, default only happens when there is a jump in the taste type after political turnover event. So therefore, we conveniently obtain the interest rate form, which greatly simplifies our life and makes the problem tractable in capturing the default behavior, how that feeds into the equilibrium interest rate. So it's before going into the optimal design of the policies, it's instructive to understand the equilibrium behavior absent any rules. So to set up the problem, so first of all, we consider when the governments are not in default. So this is going to be the value function of an incumbent government of type theta with asset level A. So it's on the right-hand side, we have the standard saving and consumption problem that depending on the utility from spending and on the continuation value from saving. So what is new here is that the incumbent government anticipates the possible events of a political turnover and losing power to a future government, in which case they're going to underweight the spending by the future government by a factor of beta. So here, the continuation value is captured in the second Bellman equation, where there is no further discounting here because the incumbent government underweights all future government spending equally by the same factor beta. And in addition, here they also anticipate possible future default event, taking into account future default decisions. And lastly, here in the continuation value, because the incumbent government doesn't have any control over future spending, they take as given the future spending decisions. So this model allows for two interpretations. The first one is the political economy interpretation, which we follow here. But alternatively, we can think about this as a behavioral hyperbolic discounting model, where it's the current self and the future self that's in conflict of the spending decisions. So now, when in default, the value functions are going to be similar, that the incumbent government discounts future spending also by a factor of beta. And the difference here is that when in default, they're in financial autarky, that their tax revenue is reduced by a factor of kappa, and they don't have any financial access, so they're in autarky, and they can return to the financial market at rate phi, in which event they start in a clean slate of zero debt. So without any rules on default, the government is going to default whenever its value of defaulting exceeds the non-default value. And the continuation values takes into account potential default decisions. So, to characterize the equilibrium spending and default behaviors, I use this graph where the vertical axis is the type, the taste type for government spending, and the horizontal axis is the asset or debt level. So we're looking at the region when the government is in debt up to the natural debt limit. So we distinguish two scenarios, which is going to have very different implications for the optimal policy later, whether there are savers or only dissavers. So when there is mild present bias that the governments are not too myopic, so in general, the higher types are going to spend more. So high types are going to be spending a lot and accumulating debt. So while the low types are going to be saving out of the debt. So we can imagine in this case that if a high type government start from this level of asset, and they are accumulating debt, if there is a shock to the taste, if we transition to a low type government, then there's a possibility this debt could be repaid. So let me also mention that the blue region is when the government defaults. So if somebody can potentially repay the debt, we're going to have an upward sloping default threshold. And if we transition to a high type, even higher type spending needs government default happens in equilibrium. So you need to have some savers in this economy that can potentially repay the debt for the market to be willing to take a risk and extend some amount of debt here. And in contrast, what happens is that if there are only these savers, which would occur, we can easily imagine if there is extreme present bias that nobody is willing to save for any future needs, then everybody is just saving that an endogenous borrowing limit arises in this case. And a second scenario that an endogenous borrowing limit can occur is when there is high political turnover lambda. In this case, what happens is that the default risk premium is too high that nobody can cover the interest payment at the borrowing limit. So it also collapsed to a vertical default threshold. So these are going to be two important cases that leads to an endogenous borrowing limit, which we will use in designing the optimal policy. So now I'm going into the optimal policy, and we look at the principal agent problem, where the principal is the planner. We can think of this as the rule writers thinking about the founding fathers, Hamilton, writing the Constitution of setting what the government can or cannot do. So there's asymmetric information that the principal doesn't observe the true type of the government. So there are many reasons to believe that the government are better informed about their own spending needs, or alternatively, we can think about the type being uncontractable. So you cannot, even when it's observable, you cannot write a rule contingent on the political party. You cannot write a rule that's specifically targeted to the left wing or the right wing parties. So here, the principal chooses an allocation for each type and asset level subject to the truthful revelation of the type to maximize the ex ante social value, social welfare, subject to for each type. So this is the value for the government of a type theta, taking into account their potential default decisions that they would tell truthfully their type rather than pretending to be some other type. And given the other factor that the planner also takes into account is the corresponding market interest rate that's going to be charged to all types of governments. So here, the planner maximizes the ex ante value. Some important things that this gives rise to a price externality that the planner also takes into account, that even when there's perfect information on the types, the planner might want to choose different default decision from the agents by taking into account that somebody's default decision is going to affect the interest rate charged to other across different types and decide differently. So to characterize the optimal allocation, the incentive compatible allocation that induces truth telling, we have a lower bound and an upper bound on the debt levels where default risk emerges, and we have a debt dependent spending threshold. So as in the literature that here the spending rules is going to be a spending limit, that the low need, the types with low spending needs have the discretion to spend according to their optimality condition, while the high types above the threshold is going to constrain to the desired spending of the threshold type. And we also introduce here the default rules that at intermediate level of debt, we allow the government to have the discretion to default according to their own choice. And at low levels of debt, we force all types to default. And at high levels of debt, and at low levels of debt, we forbid anybody from defaulting. So just connecting a bit to the literature that so this is what we would read from Manuel's work, that without the possibility of defaulting, so given how much debt there is, regardless of how much debt there's a constant level of discretion that satisfies this equation. And here, so this basically summarizes our key finding is that when the default risk emerges, we wanted to set a debt-dependent discretion that you might want to reduce the level of discretion. And we also introduce the regions where we want to forbid or force default. So for the remaining minutes that I have, we will look into exactly how these different parts can be characterized depending on the economic primitives. So, okay. So first of all, why we are forcing or forbidding default. So the basic intuition is that default is a binary decision. So it's impossible to induce truth telling according to the desired default decision of the government. So sorry, let me go back. So as before, looking at this scenario when there are savers that giving rise to an upward sloping default threshold, this is the desired default threshold by the planner if the planner had perfect information. So if the planner, for any kind of default set or non-default set the planner chooses, it's impossible to align the agent's decision because the set is binary, that whoever is misaligned will have an incentive to lie. So what you can do only is in this region, imagine that the planner definitely does not want it to default when some type of agents wants to. So you are going to force to forbid default here. And same here, that when the planner wanted to default for sure, and while the agent might not want to, you're going to mandate default. So something like this, but we're not done here. Imagine that we're in this threshold here, that the planner can do better by moving further left until the average error evens out. So something like this would characterize the regions that we wanted to force or forbid default. And in the intermediate level, we have discretionary default. And it's possible we have a double intervention on both sides, or alternatively, it's only a one-sided intervention or no intervention at all, depending on the relative positions of the two functions. So this is the result that characterizes the optimal spending threshold, it looks a bit monstrous, but it's actually very intuitive. That we, on top of the standard formula, we introduce a few additional effects when default risk emerges. So the first is the disciplining effect, that when interest rates, depending on the spending threshold, that feeds into the default threshold and the corresponding interest rate charged for the agents, there's going to be a disciplinary effect coming from the price itself. And then there's an, so this is the term that also is in Halleck and Yarate, when they endogenize the interest rate. And on top of that, we have the income effect coming from increasing level of debt, and it's going to be a negative effect because we're in debt. And there's an insurance effect by allowing more discretion, that we have a better, we achieve a better insurance by responding to different shocks. And finally, we have a debt manipulation effect, that how we set the fiscal spending threshold is going to affect the marginal types of the government who's allowed to, who's indifferent between defaulting or not. And we know the size of the first three effects, and the last one is a little ambiguous. So overall, it's difficult to determine whether it's increased or decreased discretion. But still, some simplifying simple regimes still emerges. So if there are severe present bias that so if beta is below the lowest type, we take away all discretion, which is also the standard result. But if there is mild present bias, then we allow some discretion. And in general, in the non-default area, it's still debt independent because there is no concerns for default. But in the default risk area, we might have increased or reduced discretion. But we know for sure that at very low levels of debt, as debt increases to a very high level, the negative income effect is going to dominate, and we have reduced discretion. And in terms of the default rule, so recall earlier that if we have severe present bias, that we're taking away all discretion for spending, so everybody is going to be a dis-saving type, and or if there is high political turnover, that these are the two scenarios when an endogenous borrowing limit arises, then the optimal default rule is going to be a debt limit. So this brings out the additional economic primitive from the cost of default, which gives rise to different regimes as well. If there's no depending on whether, so if there's permanent exclusion that once defaulted, you're excluded from the financial market forever, the corresponding debt capacity would be this level depending on the revenue loss in the event of default. In this case, it turns out that you don't need to set any default rules at all because the default incentive is perfectly aligned. And when there is no default cost that you return instantly and there's no revenue loss, the debt capacity is zero. So you wouldn't be able to borrow, and the planner will want to do the same. So it's sort of like a rainy day fund that you can only save for the rainy day. And otherwise, with temporary exclusion, turns out that the government, the planner wanted to tighten the borrowing limit and default before the government does. So this is because the agent is myopic in both the benefit of defaulting and non-defaulting. So this is scenario when they don't fully account for the benefit of default and they are actually holding on to too much debt. You wanted to force them to default. So I'm almost out of time. In the
Lian,
last minute.
Yeah.
Sure. That I wanted to also highlight the last factor that can shape the different regime is even when there is mild present bias and low political turnover, if the types are sufficiently dispersed, then the low type is willing to save, giving rise to some regions with default risk. But if the types are relatively homogeneous, then nobody's willing to save, and we go back to the endogenous borrowing limit scenario, and there is the optimal default rule is a debt limit. So let me conclude that we have a few extensions allowing for richer setup and contractable economic variables, and we have some quantitative applications to some different European countries in mapping them to different regimes and in prescribing more precise quantitative prescriptions. So I conclude here.
Thanks, Lian. And our discussion will be Manuel.
Can you guys see my screens?
Yes, not
Yes.
compiled by LaTeX, I assume.
There's a special font. It's called my font. I remember my first discussion I ever did when I was an assistant professor was Tom Sargent's paper. So obviously it was very stressful. And at the time we were using, still we were using, transparencies. And I did it by hand too, although it's way more convenient. Anyway, so thanks a lot to the organizer for inviting me to discuss this paper. And I think, Lian, you gave a fantastic presentation. I'm actually very clear discussion. I will suggest actually, and hopefully, and recommend that you guys include, some of those graphs that you show in the slides in the paper. I think it will really help to understand the mechanics of what's going on. So, I mean, you do have some of them, but the whole region of saver versus dissavers and how that interacts with the boundary of default is interesting, and it's actually not so trivial to understand, and it makes sense. So it would be good to have that in there. Anyway, so let me give you a quick overview, and I'm not gonna revisit the model. I'm just gonna give the authors, I'm gonna take this as slightly like a referee report and give a few comments and then a little bit of the big picture for the authors. So the overview is it's a big question they are trying to understand, and there's a lot of interest on how do we design fiscal rules when the politicians can misbehave, okay? And there are many ways we can go about writing models of political economy with frictions. And they go one way, which I like, is natural one, when there is party turnover, and the party in power values spending more than when it's out of power. That's kind of the key thing. So that generates endogenously an impatience in the model. I mean, you want to spend more when you're in power than when you're out. It can map into hyperbolic depending on the way we model that transition of power process. And this leads naturally to overborrowing, right? Because the decision maker is more myopic than what the citizens are. So the assumption here is that the citizens don't have that extra valuation on the minor utility when you are in power. And then, we should start with that premise, and we want to put rules, right, to constrain spending. And there's a lot of work on this, and the authors are kind of aware of it. I think the novel dimension that they bring in terms of the policy discussion is this control of the default decision. We have models where the spending is regulated. I mean, maybe because of some budget rules. And they're also thinking about, well, what if you could also manipulate that default decision? Would you use it? And how? And the final objective is really to increase, the welfare of the citizens, and see how far can you get. So this paper is going to focus on the combination of A plus 2 plus B. Okay? So it's trying to think of these two things together. And I see several contributions, which I think I like. I mean, it's a very elegant model, I have to say, and it merges several antecedents that are there. Merging the commitment versus flexibility environment with the default. I mean, that's a very nice thing to do. I'm surprised they're able to characterize so much about the equilibrium. I mean, that's really nice. I think they have built a machinery that is very clever, and they can extract a lot of insight from it. They provide a characterization of a planning solution. I mean, that's the planner is the one who wants to regulate the decision of the government who is misbehaving, and as well as providing numerical analysis of what comes out. All right, so those are kind of the summary of and the main takeaways in my view is that spending rules that constrain governments affect the sustainability of debt, obviously, and may increase the level of debt that are sustainable. But default rules may go either way in encouraging default or actually disallowing default in certain states. Okay, and I'll go back a little bit later about that. So what I'm going to do next is just go a little quickly, so a couple of comments that I have and some suggestions for the authors about how to handle certain things. So here's the model, right? So I think Lian gave a very nice description. The idea is that when you are in power, there is an extra valuation that you receive as compared where you are out of power. And that valuation is captured by this beta parameter, that discount. You transit, in power, you get a minor utility theta. That theta is private information and give, in principle, the role for the desire to give some flexibility to the government to tailor his spending to the shocks. Because we don't know the shocks, we cannot really control what the government does, so we need to design a rule in advance, not knowing what the realization of theta is. And the government moves out of power and then discounts the future because it's out, right? And that leads rise to these hyperbolic fissures. And an important thing is once you're out of power, you don't control the spending anymore. The spending is in the hands of the new guy. And the economy keeps receiving shocks throughout. So one comment is we like you guys to think about this, whether you can separate the turnover risk from the spending risk. They are conceptually two different beasts, right? Like a war doesn't come necessarily when you change governments. And now in your environment, they are linked by construction, and I can see the beauty of the tractability of having these then together. But you can try, I don't know how far can you go, like try to separate them somehow. I mean, one possibility obviously is to have them being drawn independently as Poisson rates. And then we can talk about, okay, is it the insurance component that comes from the theta shocks that I care about, or is it the risk of the land that is coming through? There are two different economic animals. So it'd be nice to separate them. I mean, an alternative is maybe keep the one shock assumption, but manipulate the probability of a theta switch so that in principle you can control the risk of government shocks and separate them from transition of turnover, because you can control something like the probability of a transition times the probability of a switch, keep that fixed, in essentially controlling the probability of a theta shock, and then move around lambda. What if we have more disagreement, a bigger transition? I think that one, at least, I think you could probably try to do, since it seems to be such a big deal. Some of us manipulating the distribution of the shocks that you get, and it might allow you to, when you're doing the counterfactuals and the numerical analysis, to separate shocks from political transitions. They are not the same beast. A second comment, which is very nice, and Leanne, I like your picture of the on the boundaries. When I was reading your paper, I was thinking, okay, fine. So this is a model where I will expect something like Bühler-Rogoff to hold. Okay, so what that I mean, the level of sustainable debt is basically the present value of the default cost discounted at market prices. That's what Jeremy and Ken did in their AER paper a while back. That's it. That's all you can sustain. If there are no punishments, there is no debt that you can sustain. And this holds true in your model, right? When you are at when the agent is borrowing or it doesn't save at the boundary, right? The amount of debt that can be sustained at that point is exactly equal to that present value of cost discounted at the market prices, not at the discount rate of the government, at the market prices. Now, the beauty of your setup, which it took me a while to get, is that this doesn't hold if the government is reducing debt at that boundary, and that's important for those type-specific default thresholds that Leon was showing. The probability, the risk in the model arises from these type-specific default thresholds. That's what makes this model risky and interesting. That's why there's a spread in the model, and they are coming because certain governments are going to behave differently at the boundary of default risk. Some of them will save. And those that save, those that save are different beasts, because when you default, you cannot save, right? And that kind of makes default and repayment move away from that Bühler-Rogoff risk, right? There is more value now on repayment because you can manipulate your consumption profile in a way that you cannot do it when you are defaulting. So that's nice, right? So that brings an endogenous connection. I mean, one thing you guys could do is to allow the government to save upon default. I will imagine in such a circumstance, just like in Bühler-Rogoff, then the debt limits are going to be type independent, right? So it's going to be a function of just the present value of the default cost. And that would be like a simple benchmark that you guys can work out and see, it still doesn't mean, anyway, so that was something in principle could be worked out. And it could be like a special case of your model where you call it a borrowing limit. It's basically risk-free borrowing limit. So there's a risk-free price and a borrowing limit that hits you, and it's dependent on the types. All right, so comment 3. The mechanism design. I had trouble with this stuff a little bit, and I think I got it at the end. I think part of the problem is that the mechanism design, the instantaneous bond, and the no commitment assumption on the planner is a tricky stuff. It's tricky. It's not the usual thing you have in mind. Instantaneous bond is a tricky beast. Effectively, it's almost like a promise keeping on the lender. The no commitment assumption in continuous time is also a bit tricky, so anyway, so I think here I will suggest not necessarily as the main thing that you guys want to think about in the paper, but as an addition is to think about, okay, suppose I have a discrete time version. This is not the one we're going to solve. Okay, this is not the one I'm going to use for the techniques, but I wrote it down. And then eventually I'm going to take the limit of that discrete time towards this finite horizon, so this continuous time. And then there be kind of, what are the conditions that we need to impose on this problem to get at the limit the mechanism design problem you guys get. That should not be in principle too hard. I'm not asking you guys to solve that problem, but I think it might be helpful to have in your heads and maybe in the reader's head a representation of what this mechanism design is. I mean, an alternative is to design a rule, and you guys talk about this as of the beginning of time, and just follow it, right? Contingent on shocks, rather than having almost like a Markov planner that is every period optimizing. That's a trickier one. And I think it makes sense just to, what does that mean? Do they have commitment for maybe a period, but in an instant, what does that mean? So clarifying that a little bit might help in understanding the mechanism design problem. So here's a formulation that I wrote down quickly. How am I doing on time? I'm almost out, no?
Yeah, 1 or 2 minutes.
Yes. Okay. So I have so much stuff to say. But anyway, so maybe you guys and the authors and I can talk later a little bit more in an alternative venue. But here's a discrete time formulation of the problem, right? So 2 periods on effectively today and a continuation, right? It's today and a continuation. And beta is the discount rate that the agent has. There are default thresholds or default and repayment sets. This beta is a disagreement between the agent and the planner. It's the political economy distortion. There is a payment, it's a budget constraint that needs to be satisfied. Income plus assets, revenue have to be equal spending plus stuff being saved. And I think the assumption is that the instantaneous bonds, what it does is that there is a promise keeping on the lender. The value that you need to deliver to the lender as of the beginning of the period is fixed. It's the amount of the bonds outstanding. And then what you do, then you manipulate the non-default threshold. So I have to change the payments, the interest rates that you're gonna charge to make sure that the lenders break even. And then you solve a problem like this. This might be, and then go back to one of the questions. Yeah, the planner can control the default decision today, and as you know, usually we like to, right? Because the planner, if there is no disagreement on the default decision, when the party defaults, there is a loss generated. There is a penalty that shows up, but the party doesn't care. It's indifferent. But the lenders do. The lenders get nothing. So obviously, if you think of a planning problem, you would like to get that guy who is indifferent not to do that decision, and you generate a huge surplus to the lender. And that tells you already there is a desire to manipulate that default threshold. But you guys point out another point, which is very interesting, that the way in which the punishment is affecting the parties is different too, because the punishment may be front-loaded, and the government may not default because the punishment is going to accrue very fast in their view, as compared to what the planner we want it to be. So that's nice too. Anyway, so I'm just gonna end up with one thing that you could do, and I think it may be help in understanding what's going on. Kind of like a decomposition of the welfare gains that arise from introduction of the planning solution. Just to quantify a little bit, how much do we get? And I did something like this with Mark and Stelios, which is a student here. And we could think of like 3 ways in which we could decompose the welfare gains. But like the tilting, the volatility that you get, and then the deadweight losses of default that are incurred. And I wonder, and we said that in most sovereign debt models, is the later one, is number 3 that is big. Is these deadweight losses that are big and you want to eliminate? And my question to you guys, is that true in your model too or not? Is that the dimension that we worry about with designing these rules? Or is it really something more about insurance and having the ability to tailor your spending to theta that is key now? Anyway, so conclusion, this is a very nice paper. Sorry, I went a little bit over long. The continuous time formulation is really elegant. This have a new combination of potential policies that is interesting. And I really enjoy thinking about this disagreement on default cost with reentry due to the timing and the impatience of the parties. Final notation tip, you guys are writing a debt paper, embrace B. Write everything in debt levels, not assets. Drives me, confuses me. Just go, embrace it. It's a debt paper. It's not about assets, it's about debt. So B is a state variable, not minus B. All right, so I'm done.
Okay, thanks, Manuel, for the excellent constructive referee report. Usually referee 1, not referee 2. So Leanne, you want to take maybe 2 minutes to respond, and we can give the ground to the floor. the audience.
Sure. Yeah, thanks very much, Manuel, for all the excellent comments. They're very useful, and I really like this old technology of doing the slides, and we also realized while we were getting ready for this workshop that our pictures are not in the draft itself, and with my co-authors, we were saying we should include them. That's going to make Manuel's life much easier. And very briefly regarding the comments, the first one is separating the shock to spending versus the political turnover. In the chat box, my co-authors were also here. They have another paper which is exactly about separating them out, so they might have something more to add, additional insights coming from that. And regarding the second one, in allowing the agents to save in default, I think that's a really useful comment. Essentially, it's going to allow us to separate out the confounding costs in default, and actually when they can save, it's just about the reduction in revenue might make our life much easier and have additional convenient characterizations. And finally, regarding the third comment, we were thinking also hard about all the additional commitment issues that are involved. So the assumption here is that we are considering policies that doesn't require any commitment, and so we're solving for each debt level. So also switching from A to B, and we kind of like also struggled a little bit in the tools to use for discrete time versus continuous time, and in thinking about how the optimal, more generally, the shape of the optimal policy. In particular here, we're also assuming history independent mechanisms that we're not entirely sure. Hopefully we will have a more concrete answer regarding that. And finally, the decomposition of the welfare gain I guess that's more in the quantitative part. We're hoping to have a more concrete quantitative analysis that my intuition would be that depending on also on the regime and parameters, that one component might be dominant the others.
Okay, thanks, Leanne. And maybe we should take one or two questions from the audience. I saw a lot of lively discussion in the chat. Please feel free to.
Yeah, so I think the question is partially addressed, but it's important to know whether the citizens also have this kind of myopic decision making, because in reality we know people just focus on the present and they don't care about the future. So it would be nice if you can elaborate why the social planner. So who are the social planner and why they're not subject to such kind of behavior?
So right, so in the if we follow the hyperbolic discounting interpretation, then I guess we could interpret it's being the discrepancy between the government and the agents. And in the political economy interpretation, it's more measuring the disagreement and polarization between different parties, that they're catering to their own constituents and they simply overspend. Yeah.
So let me add that something to that is like, suppose the society knows that it has this problem and they see it, and before their life, they decide to do something about that. And they impose these rules. They say, look, I know in society, as a society, I don't behave well, So I better put rules to control myself. You can also interpret it like that, right? I do that.
Yeah, I mean, that's the micro foundation for hyperbolic discounting. Right? You want to control yourself.
So there is a beautiful paper by Jackson and Yarif. It basically says that a society, when you aggregate the heterogeneous income factors, you lead to a social welfare function that is time inconsistent. So is it going into your question?
Okay, thanks everybody. I think it's about time to move to the third paper, considering that a lot of our audience is in China time. Okay, so I handle this to our co-organizer, Ernest Liu.
Okay, first, thanks, Lian, for the very elegant paper, and Manuel for the insightful discussion. It's always nice to see discussions from a master of the topic. So the final paper of today's session is joint work by Wenhao Li from University of Southern California and Ye Li from Ohio State, who will tell us about how direct lending made by central bank can distort firm quality distribution. And Hui Chen will be the discussant. Wenhao, please.
Okay, hello everyone. So it's a great pleasure to present a paper today, and thank you conference organizers for including our paper in the session. Just to remind you, this is the last talk for the whole two-day conference. It would be great to see everyone. So this is the last chance to see you in face. Please turn on the camera if you can. I strongly encourage you to turn on the camera. Okay, so this is a joint work with Ye Li. Ye is also around today. We are motivated by the recent new trend that it seems globally all the governments are trying to scale up their interventions in the private market. It's a very obvious trend, especially with the recent news, the new administration's intervention. One particular outstanding phenomenon is the central bank direct lending to the firms. Now, this seems to become a new norm. So post 2008 global financial crisis, the Bank of Japan, European Central Bank, and the Bank of England, they all started their corporate bond purchase programs, which deviate from the tradition that the central bank only lend through the banking sector and financial market. And then during the COVID-19, the Fed joined the other central banks. So they started their corporate bond credit facilities, including primary and the secondary market. And furthermore, this step even further, they started the Main Street lending programs, which directly hold corporate loans for small and medium firms, which provides the same interest rate for every firm that participates. Now, undoubtedly, the government interventions in time of crisis is needed in order to avoid the aggregate externalities. However, we're eventually going out of crisis, right? Like the current COVID crisis, we are on a recovery path from that. But what we are always concerned about is going forward, how would the large-scale government interventions affect the post-crisis recovery? And furthermore, what about the effectiveness and scale of future interventions in future crises? How would that feed into what happened into the future? So those are the questions we are trying to address in this paper. So our view is that although the government direct lending boosts aggregate investment, it also distorts the firm's quality dynamics because of a fundamental friction that is a lack of differentiation across firms of different qualities. So we take this lack of differentiation as a key feature of government-led programs. And indeed, that is a key feature in reality. Like, for example, the PPP program, Paycheck Protection Program, offers 1% interest rate for all the firms. The Main Street lending offers LIBOR plus 3% for all the firms. So it's a very general feature. Now, why is that? Well, if you look at the discussions in the policy circle, I think there are mainly two reasons. One is political, as Lian's paper was focused on. There's a strong political force. It's unfavorable politically to say that the government program discriminates different firms, especially in time of distress. The second reason is more of informational. It's a long tradition in economics that we think that central authorities lack the information of private participants, starting from Hayek. Therefore, we build this into the model. And because of the lack of differentiation, what the government do as a reasonable policy is to provide the lending terms that is above the extremes. So that is between the best fair value for the best quality firms and the worst and the rate for the worst quality firms. As a result, immediately in a crisis, there would be distortions. What would happen is that high quality firms overpay for government funding, but low quality firms underpay for government funding. The concern here is that the natural cleansing effect of a crisis is weakened. So what is a cleansing effect? In a crisis, higher quality firms have better capacities and better firm values, and their financing capacity is higher, so they can make more investment. And as a result, naturally, emerging from the crisis, the ratio of high quality firms would be higher.
So
and that would improve. Yeah, sure.
Can I ask a clarifying question? So high quality firms overpay relative to what?
Relative to its fair value.
Okay.
So there is a fair price in mind, right? So high quality firms should be cheaper because they're high quality. Should be more expensive for the funding for the low quality firms because thank you. So there's a natural cleansing effect, but this is weakened by the government intervention because the government is providing the same rate for firms of different qualities. Now apart from that, even outside of crisis, absent from the actual crisis happening, the pure expectations of future intervention would feed into the investment of high and low quality firms and distort growth. So imagine you are the high quality firms, knowing in the future crisis you are overpaying for potential government funding, you would underinvest, which is below the efficient level. While for low quality firms, knowing in the future you're subsidized by the government, you would overinvest. Right? This is another distortion in normal times. Now, more interestingly, these inefficiencies are highly self-perpetuating. So what I mean is, if in the current crisis, the government intervened and provided credit, then that will cause immediate distortion of quality. Right? That is quite persistent. So in the future crisis, for this to achieve the same policy goal, let's say the same GDP drop, the government needs to intervene at an even larger scale because of the previous distortions from the last crisis. And therefore, intervention begets more intervention. It's a highly self-perpetuating. And we also show that in terms of welfare, gradualism of policymaking is highly beneficial. So tight government interventions always improve welfare, but aggressive ones, like probably we observed recently, usually decrease the welfare. And we also extend our model to bank market power and corporate liquidity management. If we have time, we can go into those extensions. Now, let me set up the model. So let's first look at the benchmark economy without government intervention. And then we're going to look at what happens under government intervention. So this is a continuous time economy without government and a unit mass of households. Households are risk neutral, and the C here is a cumulative consumption process. And we have a continuum of firms of high quality and low quality. The only difference between these two types of firms is their productivity. So per unit of capital, high quality firms have a higher productivity. And these firms are equity only. Right? So we intentionally make their capital structure simple to focus on our channel of capital distortion, quality distortion. And the literature has already studied the capital structure frictions like that overhead. And then in this model, the capital values, Q, is endogenous. They're determined by the expectation of what happens in the future. So this is very important because it's forward looking. So whatever would happen in a crisis would feed into today's value of capital and affect the investment behavior of the firm. And we summarize capital quality simply as its omega, which refers to the fraction of the high quality firms. So it's a very parsimonious way to describe quality distribution. And then the total output of the economy is simply the total amount of capital K multiplying the average productivity of the economy. Of course, this average productivity is related to the fraction of high quality capital. So if the omega is higher, the productivity of the economy is higher. Now, in normal times, there are investment opportunities which arrive at idiosyncratic Poisson shocks. So think about this as lumpy investment by firms in normal times. It's important that they are idiosyncratic, so they wash out in aggregate. So in aggregate, the investment is very smooth in the economy in normal times. So here is investment technology. So for XK units amount of consumption goods, we can transform that into FX K units of capital. So you can see that everything here is scalable with respect to capital K. This is following the long tradition in the investment literature started by Hayashi. Then naturally, there is a target investment level, which we call iota bar, which maximizes the profit. And this is determined by the standard Q theory. So what it says is that the marginal cost of making investment is equal to the marginal transformation into capital, multiplying the value of capital. With a standard F function, with standard properties, it's easy to show that if the capital value Q is higher, then their target investment level would be also higher. And in our model, it's generally true that more productive firms have higher value of capital, so QH is greater than QL, which also implies that the iota bar H, the investment target of high quality firms, is higher than the investment target of low quality firms. Okay, now firms in the time of investment opportunities are also subject to collateral constraint. So many of you might be very familiar with this constraint because it's highly standard in the literature. So the amount of a new investment, XK, should be smaller equal than the value of a capital QK multiplying a multiplier chi. So this chi basically says you can't post all the capital as collateral. Right? There could be some intangible capital, some fraction of capital that could be lost during the liquidation process, and so on and so forth. You can interpret this, the reason for this private agent to subject to collateral constraint is limited commitment, right? So the firms cannot credibly commit to pay back the household, which is a quite general friction. We follow the tradition in the literature of occasionally binding financial constraint. So we assume that this collateral constraint is not binding in normal times, but it's going to play a role in a financial crisis. Now let's look at crisis. So crises are systematic Poisson shocks with intensity lambda, and that hits all the firms. But the crises are also opportunities. So during a crisis, firms can also make new investment to rebuild their capital. And for a single firm, but what is different makes it different for investment in crisis versus investment in normal time is that firms are subject to destruction of capital. So for individual firm, the U fraction of capital is destroyed, and this U is randomly drawn from the same distribution for different firms. Then the collateral constraint changes into the following. That is, new investment is below the collateral value of capital after the destruction, which is 1 minus U. So clearly you can see that this is tighter compared to the constraint in normal times, right? So if U is big enough, for sure, this constraint is going to bind. As a result, in the model, what happens in a crisis is that a fraction of firms with very large shocks are going to be financially constrained.
Can I ask a question?
Yeah.
So you said the firms are fully equity funded. So here the collateral constraint is on issuing new equity?
Right, you can think in that way.
Okay.
Yeah, the commitment problem could be universal, even with a different type of security. Yeah. Thank you. Okay, now let's look at firms' investment and financing problems. So first, firms' profit to investment in a crisis is simply the profit out of a new capital, which is Q multiplying X, minus the investment cost, right? So the investment consumes resources, subject to the collateral constraint. And you can see that it's more binding for large use. But this is a more of an ex-post problem. Ex ante for each firm, they don't know the potential shock of U. So their expected profit ex ante is an expectation over U. So you can see that what happens in a crisis is going to feed into this expected profit. And this expected profit is going to feed into the capital pricing equation. So here is an important equation that kind of links the future from today. For households, they are risk neutral. So for any asset they hold, it will require an expected return of R. And when they hold capital, there are 4 terms in terms of the returns, right? Capital produces output. There's also depreciation. There's a profit from a normal time investment. And there's also investment profit and the destruction of capital in crisis. Right? So U here is the expectation of the smaller lowercase u. So this is a very important equation that gives rise of the expectation effect. Okay, with all of this, now we can see that what makes the model very tractable is that the capital values in investment are constant. And we can also prove that the high quality capital, the value is higher than the low quality capital value. Now, to understand the model, let me give you an intuitive illustration. For those of you who might get lost in the notation previously, this graph is what you can immediately understand what I'm saying. So here, what I'm showing you is allocative inefficiency with only the private market. So in financial crisis. So remember, this is a static perspective given QH and QL. Because QH and QL are endogenously determined. So there is a further action for QH and QL. But now let's keep them fixed. Let's take a snapshot for what happens in a single crisis. So now you can see that for H and L firms, they have potential investment projects. Right? For H firms, they have this target investment level, iota H bar, that is statically efficient. But if they invest too much, the projects become inefficient, right? So you can see this gray dots, they're inefficient projects, potentially inefficient projects. For L firms, similarly, but a different color. And I already told you, QH is above QL, right? So as I mentioned, naturally, the investment target is higher for each firm. So each firm would love to invest more compared to L firms. Now, what happened with the private market? There is a collateral constraint, so the firms cannot borrow up to their efficient level. So what happens is, they can only invest a fraction of what they would love to. So you can see that high quality firms invest, let's say, $3. Low quality firms invest $2. But again, if you look at this investment collateral constraint here, it's related to the value of capital. So because QH is bigger than QL, this constraint is loser for the high quality capital. So high quality capital, high quality firms can make more investment, even with the collateral constraint. So that's what the graph illustrates here. Right? In a static allocation with the private market, although they are both credit constrained, the high quality firms still make more investment compared to the low quality investment. And this gives rise to the so-called cleansing effect of a crisis. That is, emerging out of a crisis, the fraction of high quality firms would be above the fraction of low quality firms. This increase of quality on average is beneficial for economic recovery. Now that's the static view, but we can also illustrate this cleansing effect in a dynamic in a simulation. So here we simulate the model for 40 years, and we show the two key state variables. One is the total quantity of capital, and the other is the quality of capital, omega t. So don't take the numbers too seriously here, just to illustrate you the mechanism. So before a crisis, you can see that the capital is growing. And in a crisis, we have a destruction of capital. And afterwards, we have recovery. In terms of capital quality dynamics, you can see that in general, it's increasing over time because high quality firms make more investment, even in normal times, right? But what makes a cleansing effect in a crisis is this jump. You can see that in time of crisis, there is an upward jump in terms of capital quality. That is what we refer to as the cleansing effect of a crisis. Because of this immediate improvement in quality of firms, if you measure the slope here versus slope before, you can see that the slope of the recovery or the economic growth is faster immediately after a crisis. Now, this gives you the benchmark economy. Now, let's think about what happens under government intervention. So far, what I told you is, under private market, we can perfectly differentiate H and L firms, but we're subject to credit constraints, which fundamentally because of lack of commitment. For government funding, it can resolve the credit constraint. Well, this is a typical idea in the literature. The government has this fiscal power, has taxation that can avoid a limited commitment problem of the firm. However, the government cannot discriminate firms. As I mentioned at the beginning, this is indeed a key feature in the observed programs for government, like PPP and Main Street lending. And the two motivations, one is political constraint and the other is information disadvantage. But we will take this as a given in the model. So we basically, the government offers the same term for all the firms. And we model government financing in a simple way. That is, for G units amount of government financing to type J firm, the government is going to ask for gamma multiplying G units of capital as repayment. Right? So literally speaking, the government is asking for equity shares of the firm in exchange for financing of the firm. So obviously, this is a technical trick for modeling government financing. Like the QE papers by Gertler and Kiyotaki, they actually use this. But we find another new home for this technique in our setting. So the gamma T is the same for both types of firms. So as you can see that this funding is more expensive for high quality firms. Why? Because the high quality firms' capital is more valuable. If they pay the same unit, they are actually paying more in terms of the value. Now, with the government intervention, now let's rethink the problem of firm financing in crisis. So firms have a more option. That is, firm can choose between the private market versus government financing. As a result, the problem looks a little bit different and more complicated. So you can see that the firm's profit is basically the value of a new capital multiplying the newly created capital. And there are two sources of financing. One is X, which is the financing raised from the private market. It's a competitive market, so every unit of a real resource is a costing 1 unit of real resource. Right? So here, basically, you can imagine there's a 1 multiplying X. For government financing, it's different. So for G units of government financing, the government requires gamma units of capital as repayment, right? In terms of real value, you have to multiply the Q, the value of capital. So the multiplier or the cost of government financing is simply QG gamma T for capital of type J. As a result, as I mentioned, it's more expensive for high quality firms. And still, the firms are subject to this collateral constraint. Now, let's look at what happens depending on the cost of government financing. So first, suppose that government funding is cheap. Cheap in the sense that this multiplier here is below 1, right? So then it's cheaper than the private market financing. In that case, the firm would finance only everything through the government. Now, in another case, if this multiplier is above 1, then it's expensive. In that case, there is a pecking order of financing. So for firms with small shock U, they are still unconstrained. So they would prefer to use their own private funding from the private market to achieve their target investment level. But if the shock U is too large, right, there's too much capital disruption, their collateral value declines too much, and then they would first exhaust the private funding capacity. And after that, they would supplement with government financing. Now, as you can see, it doesn't make sense for the government to provide funding that is either too expensive for everyone or too cheap for everyone, right? Because it can easily improve in the outside of boundary. And therefore, we restrict this gamma charged by the government to be between the two extremes, which means it's going to be expensive for the high quality, but cheap for the low quality. It's somewhere between the quality ladder. And also for today's talk, for tractability, we restrict it's going to be a constant, but we also solve for a case where gamma can be state dependent. Again, now let's draw your attention to the similar figure. You don't need to know the model to understand this figure, but now we have the government. So let's look at the allocations with the government. Again, given the QH and the QL. So I'm going to talk about QH, QL in the next slide, but for now, let's take it as given and think about what happens in a single crisis. So you can see that with the government financing, because it's cheap for the low quality firms, what would happen is that the low quality firms would finance everything through the government. Here, everything not only includes the efficient project in the blue dots, but also the inefficient, some of the inefficient projects, right? Why? Because the government financing is too cheap compared to the fair value. As a result, it would overinvest, and that would have inefficiencies here. Now, for the high quality firms, what they would do is they have pecking order, right? Because government funding is expensive for them. So then if they are subject to small U, small shock, they are going to finance through the market. But that capacity is highly constrained. And with larger shock of U, they would prefer to get financing. So sorry, they would use up the funding from the market, and then they raise the rest of financing from the government. Right. So if you look around, the H firm's total investment here, if you sum up the market and the government, is still below the efficient level, which has 6 dots, right? The reason is still because the government financing is expensive. So with that cost, they can't reach up their efficient level of investment. So you can see that there's 2 ways of a distortion. So high quality firms are not receiving good enough treatment. So their investment in a static way, in a static view, is below the target level. While the low quality firms, they get subsidized by the government. So they invest above the target level. So that's what we mean. Government intervention drives quality distortion. And furthermore, if you look at the ratio of investment between high quality versus low quality firms, it's actually become smaller compared to the case without government. So that is saying with the government, still the high quality on average would invest more than low quality firms, but the ratio is smaller, meaning the cleansing effect is smaller. So emerging out of a crisis, average quality would be lower with government intervention.
Well, how can I ask a clarifying question here? So
yep.
I feel like, I do understand that the cleansing effect can proportionately increase the quality, but from the government's perspective, comparing this graph with your earlier graph, it seems that the NPV decision is whether those 4 blue dots and plus the 2 green dots together is a positive NPV or not, right? Because in your graph here, all the government can do is save these 4 blue dots and 2 green dots or not. So, right?
No, the government is providing the uniform rate. So this is a very important assumption or restriction. The government cannot discriminate different firms because of the non-discrimination.
Eventually, the outcome is that in your model is that you save a bit more projects from the low quality firm, right? But
right, yes, you save more low quality firms.
Then the calculation is whether the saving these additional projects from the low quality firm is a positive NPV or not. That's all, right?
That's actually, so there are, as I mentioned, there are two so the trade-off here is the distortion of quality. That is, if the government increase the leniency of intervention, then the more low quality firms would emerge outside of that, right? The quality is distorted versus the aggregate slump of the economy because it's saving aggregate capital. So if they intervene more, then the capital, they can save capacity of the economy more. So there is a trade-off. If the government intervenes more, the decline in a crisis would be less severe. However, emerging out of a crisis, the quality would be lower. So that's the essential trade-off of the government that is faced. Here, I'm only illustrating you what is the inefficiency side of the government intervention, right? And also from a static point. Now, if you look forward, there is also an expectation effect, as I mentioned in the introduction. So what is the expectation effect is that the government funding not only immediately distorts the quality in a crisis, as I illustrated in this figure, right? But it also distorts the quality growth in normal times through the value of capital differential. Right? So this QH and QL's differential kind of controls the wedge of investment between high quality and the low quality. And we would prefer that to be bigger. So high quality firms should grow faster and have higher value. Now, without government funding, as you can see from this baseline, this gap is pretty big. But once you have government funding, regardless the pricing of that, it's going to be below. So there's immediately a drop of this wedge. And then as the government financing goes from tight to lenient funding, you can see that this gap is further going down, right? Which is actually a bad news for efficiency because we would love to have a differentiation across firm quality dynamics. So that's the expectation effect. Okay, now if we know the channel, now let me show you the self-perpetuating effect. That is, if there is an intervention in the current crisis, actually it's going to beget more intervention in the future. So in that sense, there is a slippery slope of government intervention. So what I'm trying to show you here is that suppose we want to get a GDP drop of 10% in a crisis. How much extra funding, government funding is needed for an immediate crisis due to previous interventions? So that is, we compare two worlds. One, previously there's no intervention, and the other world, there is intervention. And then let's see if for the next immediate crisis, how much extra intervention is needed in a world with the previous intervention. Okay, that's a goal of the exercise here. So then this figure I'm showing you here is that, let's compare two worlds. So in both worlds, we shut off the expectation effect. So people believe there's no intervention at all. But in the first case, which we can call it benchmark, there is no intervention indeed. In the second case, there is actual intervention during the crisis. So in the figure I'll show you, we simulate two crises. One is in year 10, the other is in year 30. And then we are plotting here is that compared to the first world, in the second world, how much extra government intervention is needed for an immediate crisis in the moment. So you can see that after the government intervention in the first crisis, going forward, if there's immediate crisis in the next second, then we need more government intervention in the second world because we have the government intervention in the past. So you can see that previous interventions really beget more intervention of an immediate crisis in the future. And it's long lasting. So you can see that this gap is growing, is persistent, and it's going to be even bigger in the next crisis. So crisis after crisis, intervention begets more intervention. Right. So given the time limit, I also have another cool figure to show you, but let me give you the idea. So not only the actual interventions would give you the self-perpetuating effect, but also the expectation effect. So imagine we're living in a world where people believe there would be government intervention in the future crisis. Now think that how would that affect the economy? What would happen is that the growth, the quality differentiation is going to be smaller in normal times. Because QH and QL is going to be lower. Because of that, in normal times, the quality is not as good as it should be. And therefore, if there is an actual crisis, we need more intervention. So without the actual intervention, the pure expectation effect of government intervention would immediately affect how much government intervention we need. And that effect, again, also accumulates over time. Okay. I think we are basically out of time. Let me show you, just describe the welfare, then we end here. Okay. So we're able to solve for welfare implications. The welfare is simply the normal time investment minus crisis, normal time consumption minus crisis investment discounted at the present value. Then you can compare the welfare under different types of government intervention. What we found is that if the government is tight in this red line, government intervention always improve welfare. But if it's lenient, as in this blue line, in a lot of cases, it's going to be a welfare destruction. So this calls for gradualism of government finance. Okay, great. I think we can end here. So feel free to ask more questions afterward. Thank you.
Great. Thanks for the presentation. Discussion will be by Hui from MIT.
Okay, can you hear me? Great. Okay. Thank you so much for having me here. I hope you can see my screen. If there's any problem, let me know. This is a really fun paper to read. I think it's, to be fair, it's probably still in early stage. I can see that the authors are still trying to work out many different kind of potential implications there. Let me be brief and first summarize what are the key ingredients of the model, and then I'll kind of highlight what I think are the most interesting parts of the results so far, and then I'll give you some suggestions on where to go. So in terms of the ingredients, actually, they are fairly standard. They have firms with heterogeneous productivity. There's a collateral constraint, and it's kind of very smartly modeled in a way that gives you tractability, which I like a lot. In a crisis, capital was destroyed, and some firms were facing especially tight collateral constraint, and as a result of that, without the government intervention, then certain firms will be potentially falling far below the desired level of investment, those weaker firms. And that's where this government funding comes in. And in particular, what I want to highlight here is this non-discriminatory pricing
constraint that the government funding faces. So I think there was a question at the during Wenhao's presentation about in what sense is there mispricing. I think the mispricing term is a little bit kind of maybe abuse of terminology, because in the end, the firms actually have the ability to choose whether they take on the government funding or not. So in some sense, when in equilibrium, the kind of a government direct lending, let's call that quote unquote, happens in a way that's still kind of maximizing firm value. Okay, so in terms of the key results, I think the first key results is somewhat standard, I would say, is this kind of a logic that is similar to creative destruction, right? So you have government intervention that basically kind of slows down this kind of a government creative destruction process, or what Wenhao and Ye call cleansing effect. So of course, emerging out of the crisis, you will find that the weaker firms would have a larger capital stock than they would have otherwise. And that actually has interesting long-term implications, in particular for future size of bailouts, which is, I think, is one of the interesting results that Wenhao showed just now. In terms of the dynamic effects, actually one thing that I like quite a bit, but maybe Wenhao didn't get enough time to talk about in today's talk, was this effect during normal times, right? So the logic basically goes like the following. Because of the anticipation of the bailout in bad time, there's this moral hazard issue during normal times. So those weaker firms will invest more than usual, relatively speaking, again. So as a result of that, the kind of the share of the capital in the economy that belong to the weaker firms will also, relatively speaking, become higher. So average quality would be lower. And on top of that, if you allow firms to save to buffer these capital loss shocks, you would have the incentive to kind of save even less than otherwise. So that would also kind of make the financial slack kind of reduced. So this kind of a double whammy is basically causing you to have even bigger need for bailout in future crisis, which is nicely shown in this simulation exercise. So I think that's a very, very nice result there. So now let me get to my first kind of comment, and this is kind of a highlight in the title of the slide over here. I can see that the authors alluded to this in their presentation, but this is really deeply buried in the paper so far, which kind of puzzles me a little bit, because when I first saw this paper, I was immediately thinking that, okay, this is what the kind of the end payoff is going to be, right? So a lot of the nice modeling choices are being made to make this model very tractable and elegant. But in the end, I think it's kind of the holy grail in some sense is really, how does this framework help us think about the optimal kind of government intervention design here? And the paper actually has a very nice kind of results for this. Maybe just like recently developed and didn't have time to be given proper treatment in the paper yet. But I certainly would encourage the authors to highlight a lot more about this. So I picked one figure from the paper, which, as you can see, is figure number 12, showing up on page 67 in the paper right now. But it shows beautifully this kind of nonlinear dependence of the optimal government policy on the share of the kind of the distribution of the firm quality there. So intuitively, yes, you would think that when the firm's average quality is high, then the cost of funding should be lower in the crisis, and vice versa. But exactly how the dependence works out is not obvious, and this nonlinearity, I think, is worth emphasizing. And on top of that, this different levels of commitment, starting from completely without any commitment to a limited commitment in terms of what the firms or the government would do just before the crisis hits, versus a full commitment of some kind of constant terms of lending ex ante, right? These different levels of commitment actually being very nicely worked out in the paper, and they can see the differences across them. That's I found pretty fascinating from the right side of the figure here. So I definitely recommend the authors to emphasize these results much more and perhaps develop them much more earlier in the paper. Okay, now I'm going to go to more substantively in terms of the comments about the results in the paper right now. So the first one, I think, is also kind of echoing what Miao just asked earlier in the presentation. So even though the quality and quantity trade-off is kind of the focal point of the paper, I think actually it's a fair question to ask, which is why actually we care about the average quality, or for that matter, the quality distribution, right? So usually we care about the quality distribution. In particular, we care about having, not so many, quote unquote, weak firms in the economy, because these government kind of interventions are keeping these zombie firms alive, right? So this is the kind of the MPV question that Mel asked earlier. So I think this is something that's actually perhaps not quite kind of the right question, or it's not the model is not really kind of well suited to answer this question, because obviously the productivity levels are kind of a exogenous fix and doesn't really change. But that's something I think the authors perhaps want to think a bit about. So I can see why, like, two reasons why you would care. One is, this kind of zombie firm being kept afloat and potentially wasting resources that way. And the other one is that there also additional this crowd out effect. Again, this is going to ask you to perhaps even endogenize the kind of the productivity in some sense, when you have more of a presence of a small firms and taking away the market share of the big firms. That obviously would be something that we wouldn't want to have, reduces the efficiency in the economy further. And that's something maybe would call for attention to average quality and quality distribution again. And these two things, as far as I understand, I think are missing from the paper, and I would encourage the authors to think about more. So when you think about costly entry and inefficient liquidation, you can actually sustain, right, both type of kind of a phenomenon and make it intricate part of the model. Now understand that from a discussion point of view, I don't have to worry about attractability, and which is one of the big thing in the paper. So this is obviously something that would require some creative thinking. The third comment is about the collateral constraints. So in a simplified version of this, you can see is the equation or inequality I'm showing over here, right? So the key thing is that the tightness of the collateral constraint depends crucially on the value of capital, which obviously is tied to this productivity of the firm. So in other words, in the economy, there's a nice link between the productivity and collateral constraint tightness here, and highly productive firms actually effectively face less of a collateral constraint, right? And this is something that potentially could be worth thinking a bit more about, because empirically we know that other forms of heterogeneity across firms can also drive these tightness of financial constraint, right? So I'm giving you an example here, which is to think about firm size. Market power, access to external, bond and equity market, and even in terms of this kind of internal capital market, the risk sharing, all of this will point to perhaps larger firms have less of a financial constraint. I think that's not controversial, but at the same time, there are a lot of theories and empirical evidence pointing to that these larger firms probably are also the firms that are less productive. So in other words, there's going to be some kind of non-trivial correlation, negative correlation between size and productivity that would actually make it in a way kind of a counteracting to the forces you're emphasizing in the paper, right? So those smaller, younger firms that are more constrained are being helped out by the government. Then, as they emerge out of the crisis, the fact that they are owning a bigger capital share, in fact, is a good thing from a quality distribution perspective. And another reason I pointed this out is because I think in this sense, the trade-off becomes a little bit more complicated to think about, exactly, again, why we care about the quality distribution. All right, I'm going to end my discussion with a couple kind of a more recent empirical evidence, because this was very much the motivation Ye and Wenhao used to kind of set up the model. So, for example, during the pandemic, obviously there was a lot of discussion about the effectiveness of the government programs, such as the primary and secondary market corporate credit facility, which is basically government buying of corporate bonds from the primary and secondary markets, as well as the PPP program as well. Okay, so let's start with the corporate credit facility. You can see here it was started in on March 23rd. It basically stopped buying new securities by the end of that year, and at its peak, the size of the program was pretty tiny. It was like $14 billion, right? But what's kind of remarkable is that just the mere expectation of the Fed buying of the corporate bond was pretty significant in its effect on calming down the market. So you can kind of see this effect pretty clearly over here in this picture. The bottom line in the red is the treasury, and the going up is AAA, and then three different levels of junk rated bonds. Just give you a flavor of the different parts of the spectrum. You can see that for the AAA bonds, basically the crisis was over by the end of March. Pretty immediately the initial spike in the spreads was basically coming all the way down. And then even if you go look for the worst credit quality here, CCC and below, it's basically over, or more or less over, I guess, by the summertime. Again, all of these keeping in mind that it's just in terms of the direct assistance that the government gave was at a very small magnitude. So that basically brings us to this kind of this question, which is, what really is the benchmark here, right? So when we think about whether the government's intervention, how effective it is, it's probably not the laissez-faire economy, perhaps, or at least can argue, maybe an alternative really is a world where there's severe disruption of the functioning of these markets, which could actually really, right, kind of snowball and make these firms suffer. And obviously, it's not a fair question to ask here, because the model is kind of a neoclassical in that sense and doesn't really address the kind of disruption of the market in this way. But it's fair, I think, in a grander scheme of things, and when we think about optimal design of government policy, this is obviously something that will show up. Similarly, when you think about the PPP program, the Paycheck Protection Program, this obviously is a much bigger program. But if you look at the recent kind of empirical studies on this, one is that its effect on employment actually is kind of small. So the Chatty et al. Paper basically documented that the increase in employment for these quote unquote treated firms are essentially at the order of 2% or more or less. But the cost per job saved by the PPP is pretty enormous, right? So the question was kind of, why is this the case? Well, these authors were basically pointing to the fact that a lot of the PPP loans actually went to these inframarginal firms that were basically not, planning to cut a lot of the workers in the first place. You can see here, which is another way to look at this, is that the kind of a size distribution in terms of the PPP loans, where it goes to, is very, very skewed. That, I think, is related to what this paper is talking about in two ways. One is that the paper actually can qualitatively generate something like this, right? Because a part of the government subsidies or assistance actually went to the good quality firms. So in that sense, is consistent. And then what's kind of interesting then is talking about, just how skewed this distribution is for the PPP. I think that's something, perhaps because you have it in your model, is actually something worth investigating and thinking about. Just how is the government assistance divided between different firms. And then maybe one last slide here I want to point out, although I don't have good data on the firm side, but we actually have pretty good data on the household side in terms of what was the stimulus really trying to do. And that makes me wonder the same question about the firms in this model. So what this picture showing is, this, by the way, this picture is using the data from the JP Morgan Chase Institute. Where they look at is basically after several rounds of government stimulus, what did the households that got these kind of stimulus checks did with the money, right? So what's kind of really striking is this fact that essentially a lot of the stimulus money was not spent right away, but rather turned into household savings. So in that sense, there was this active debate about whether this is really stimulus or is some kind of a precautionary saving kind of insurance scheme that's going on. In a way, I think I'm curious about what the authors think about what the firms are doing in the model, and in reality as well, when this is a government substance. I think a lot of it is also going to be about trying to build up their dry powder, but in terms of modeling and in terms of thinking about the implication about the distributions of firm size and quality, I think these are pretty relevant to think about. So let me end here. I think this is obviously a critically important research topic. I very much like what the authors are doing here. It's a very elegant model, and it does leave a lot of potential interesting directions to explore, as I already laid them out earlier. So I'm not going to repeat them here. So overall, I very much encourage all of you to check out this paper as well. Thank you.
Thanks, Hui, for the excellent, insightful discussion. Given that it's already pretty late, so why don't we'll have India respond briefly, and then we'll take maybe one question from the floor.
So thank you so much, Hui, for the very insightful discussions and also bringing up all the very, very interesting aspects that we could further explore. So obviously, you can see that our paper is very closely related to all the government programs, and the suggestion on further looking at the PPP MSLP firm size distribution and their lending amount is definitely a super nice suggestion. We should definitely look at that. And also thank you so much. I'm kind of slow. I didn't go through the corporate liquidity section, but Hui mentioned that. So it's a very important part that the firms actually have this precautionary motive of saving themselves out of the problems in financial crisis. And as Hui mentioned, actually that is the case. People save a lot after they receive the government money. So a key insight for that part of our model is high quality firms would save a lot, but low quality firms would not save at all because anticipation of government subsidy in a crisis. And the liquidity premium or the liquidity carry cost would control and affect its margin, and therefore feeding to how much government intervention would actually need. So in that sense, our model nicely connects the literature on safe asset shortage, liquidity premium to the credit interventions of the government. So that's a very, very nice intuition, we think that, but we don't have time to illustrate today. That's very important. And the final comment is about what is the benchmark here? In the model, eventually we care about welfare. And when you think about welfare, the government intervention is essentially trading off how much consumption, how much investment we make today, because more investment, lower consumption today, versus less investment, but more consumption today versus the future, and where the quality would play a role, especially for the growth of the economy in the future. So that's how everything tied together. So I fully agree with Hui, we should put the welfare a bit more forward and not page 62. But the reason is because we're still trying to make sure everything is exactly correct. So we are kind of doing the robustness checks, and we're going to move that forward after we are sure about it. Yeah. So maybe Ye has some comments.
I just want to thank the organizers and also thank Hui for the amazing discussion. So I think there's one point we also try to make in the paper tangentially, albeit. But so that the point is that even if we see the take-up rate in the mainstream lending program is low, and also we see the size of the actual purchases of corporate liabilities by the central bank is also not very large, right? But in our model, we do show that the sheer announcement of intervention can also help alleviate the hold-up problems of private lenders. Because if you think about the firms, especially the high-quality ones, they think, well, now I can borrow from the government, I can borrow from my relationship bank, who can actually relax my collateral constraint. So where should I go to, right? I have a better outside option from the government. Now I can tell my relationship bank to cut the interest rate down a little bit. It's really in line with the Santos and Winton old paper on this hold-up problem. But if we get rid of hold-up problem and just assume, perfectly competitive and private lenders with perfect information and the enforcement that resolves limited commitment issue, then we don't have a problem, right? We don't have the government to play a role here. So the bottom line is that we do kind of try to speak to the fact that even if the size of the actual take-up is small, but having the intervention is still beneficial. Yeah.
Okay, if there's a burning question from the audience, we can take one question. If not, that concludes the two-day workshop. I would like to thank all presenters, discussants, and participants. And maybe co-organizer Wei have some concluding words to say and announcements to make.
Yes, thanks, Ernest. On behalf of the organizers, I would like to say some words. Basically, thank all the participants, all the presenters, and the discussants. It was truly great to have the initiative of the Macro and Finance Study Group for the young scholars. And thanks to all the presenters, Jiao, Zifeng, Yang, Anthony, Li Yan, and Wen Hao, and all the senior discussants, Luca, Karen, Jesse, Adam, Manuel, and Hui for the very insightful and very constructive feedback and comments. We learned a great deal in the past 2 days. And thanks all to the participants who make this workshop possible. And for our first workshop, we are very grateful for the kind support from the Peking HSBC Business School and Sargent Institute. So hopefully our study group can start this positive loop in the future for a platform with constructive feedback and comments. Finally, there will be a follow-up version of this workshop thanks to the very high volume of submissions in August, featuring also 3 great papers as well. Then we plan to have a workshop in November and another one next May. We encourage you to give us your valuable continuous support. And thank you all, macro finance friends, and have a nice weekend and see you very soon. Thank you.
Thank you.
Thank you.